Good morning. It is Thursday, December 22nd here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith and Brian Saucy. And let's get right to the top three things you need to know as the clock hits 9 a.m. Futures in the red this morning. There was a strong rally yesterday. We also got the third read on third quarter GDP this morning was revised higher. Most markets gear up into year end with recession fears mounting for investors.
And FTX in turmoil. Yes, still. Sam Bankman-Fried landing in the U.S. last night to a long list of criminal charges after his two longtime associates both pled guilty for their roles in the fraud that led to the exchange's collapse. We've got the details for you.
And Micron shares are sinking this morning after the company announced it will reduce headcount, becoming the latest example of how the slowdown in tech is affecting employment. We'll break down those numbers in just a few moments. But of course, we have to begin today with our top story, and that is, of course, the Sam Bankman-Fried saga. FTX founder Sam Bankman-Fried is expected to appear in U.S. court today after arriving in New York by plane last night. Meanwhile, two of Bankman-Fried's former deputies are pleading guilty to charges brought against them in connection with the crypto firm's collapse. Yahoo Finance legal correspondent Alexis Keenan is here with all the details. And Alexis, a lot of details to be sure.
So much unfolding, Brian. Here's where we stand. Given Bankman-Fried's arrival in the United States last night after having waived his right to challenge extradition from the Bahamas to the U.S., he would be expected to appear in a Manhattan district court either today or tomorrow. He has to be given an opportunity to get his arraignment and a bail hearing within 48 hours of this arrival. So at the arraignment, when it does take place, he'll be asked to enter a plea of guilty or not guilty. He'll also get that bail hearing. That's up to the judge to decide whether he can remain out of custody pending the conclusion of his case. Now, just how will Bankman-Fried plead to those 8 criminal charges that he's facing? Now, that has become much more difficult of a calculus after a U.S. attorney, the U.S. attorney rather, announced in a presser late last night that 2 of FTX's former executives pled guilty to multiple criminal fraud charges. Plus, they agreed to cooperate as witnesses for the prosecution. Those 2 executives are FTX co-founder and the company's former CTO, Gary Wang, as well as former Alameda Research CEO, Caroline Ellison. Now, Ellison, for her part, she pled guilty to 7 counts of wire fraud, conspiracy against customers, as well as against lenders to Alameda, also money laundering, among other charges. Wang, he pled guilty to 4 counts of wire fraud, conspiracy to commit wire fraud, commodities fraud, and also securities fraud. Now, presumably, these defendants, for their cooperation, will get more lenient penalties, but the sentencing that they will face in the future, we don't have a date on that yet. That will be decided by the judge. Both defendants also facing parallel claims. These are civil claims from the SEC and the CFTC. That's how we saw these various agencies also bring charges against Sam Bankman-Fried. Many of these charges are identical. For Ellison's part, her penalties, if she were convicted on all of these charges. And so in theory, the sentence, even with this guilty plea, she's facing 110 years in prison and just multi-millions of dollars in fines. Wang, for his part, I believe his possible sentence goes all the way up to 50 years. Guys?
Alexis, while we have you, I mean, previously, SBF's whole defense, or at least strategy, was to try and convey that there was no intent. How do these 2 guilty pleas from his associates alter that strategy and alter the playbook that he and his legal team might have to put forward?
It's going to be so challenging, Brian. And, you know, intent is tricky business in the first place. You have to actually get into the mind of a defendant as a prosecutor and show to a jury or to a judge that they intended to do what they did in terms of committing the fraud. So that can be difficult, but if Ellison and Wang and perhaps others who were at the top ranks at FTX and Alameda and its other entities, if they're able to produce evidence that shows that Bankman-Fried and others knew what they were doing, that is going to be so problematic. So their cooperation is critical, perhaps, in this case, but we'll have to see how this really plays out. And today we could see a guilty or a non-guilty plea from Sam Bankman-Fried. We don't know what he's going to say, if he's going to continue to fight these charges.
Excellent analysis, as always. Yahoo Finance's own Alexis Keenan keeping tabs on everything FTX and the legal proceedings set to move forward from here and across jurisdictions as well. And And switching gears here, in a historic joint meeting of Congress yesterday, Ukrainian President Volodymyr Zelensky pled his case, for more aid for his country, assuring lawmakers that financial support would be used responsibly for future safety and mobility. Here's a look at what took place.
Your money is not charity. It's an investment in the global security and democracy that we handle in the most responsible way.
And his comments come on the heels of lawmakers unveiling a $1.7 trillion spending package that includes another large round of aid to Ukraine. Yahoo Finance's Rick Newman is here with the details and with a very festive hat on as well. Rick Newman, was Congress festive in their reception to the Ukrainian president?
Yeah, absolutely. He got a standing O, including from Republicans and House Republican leader Kevin McCarthy, who has suggested that maybe he won't be so eager to approve aid for Ukraine in the upcoming year when Republicans control the House of Representatives. But I think for Zelensky, this visit to Washington was a home run. He had obviously a high-profile meeting with President Biden at the White House, broadcast everywhere. That has to be a giant morale boost back in Ukraine, especially on the front lines where Ukrainian troops are dug in amid freezing temperatures and mud and misery, to be able to see their leader meeting with the President of the United States and then addressing a joint session of Congress, which does not happen very often, especially by foreign leaders. It's a huge morale boost for Ukraine. And also, it develops some momentum for future funding for Ukraine. Now, assuming Congress does pass this bill this week that would include about $45 billion in aid for Ukraine, that's a lot of money that will go a long way into 2023. But Ukraine may very well need more money since this is an open-ended conflict, and Russian President Vladimir Putin is not indicating any willingness to get the heck out of Ukraine, which is what he should do. So Zelensky here doing a really good job of building momentum for his country.
You know, and of course, the allotment for Ukraine, for spending on Ukraine, is in the current package that is before Congress. That when we talked to you yesterday, it seemed like it was pretty much at the finish line. It's had some last-minute speed bumps. And so I guess after the Congress heard Zelensky, then there was sort of a late-night negotiation session, right?
Right. I don't think this is going to derail the spending bill, but this does happen when they have these down-to-the-wire negotiations over spending bills that have to pass to keep the government open. So this involves this immigration policy known as Title 42. Without getting into the weeds on Title 42, that has to do with whether the United States can turn back migrants who cross the border without any type of asylum hearing. So Republicans want that policy to continue. It's actually at the Supreme Court right now, so it's a real cluster what to do about Title 42. But what's probably going to happen here is they're going to find a way to get this bill passed because, importantly, there are Republicans. So it's Republicans in the Senate, a few, who are objecting to the spending bill and bringing up this Title 42 issue. But there also are Republicans who want this bill passed so they can get out of town and go home. So the best thing we have going for us here is that for Congress to go home for the Christmas holiday, they need to pass this, and they need to do it by Friday. So my bet is they will find a way to do that.
I bet they will as well. All right, you better get back to Santa's workshop, Rick Newman. Thanks so much for being here.
Back in the toys.
All right, let's get to thing number 3 this morning. That is Micron announcing it's cutting its workforce by about 10% in 2023, as well as suspending bonuses in the new year. That's the latest move in the slowdown that is happening across the tech industry. And of course, the particular challenge among the chip makers like Micron is the glut in chips. And for Micron specifically, which is a memory chip maker, its product is commoditized, right? So it is particularly acute for a company like this. And Micron says it's going to try and cut back on production. It's going to try and help with the glut. But the problem is it has competitors that also make chips. So unless everybody does this, it's not necessarily going to help the problem.
Yeah, I have like 8 things to say on this Micron, but I'll try to distill it down to 4. One, of course, the 10% workforce reduction, that is a huge reduction for a company that Micron that has been, I think, touting its growth growth prospects throughout this year, investing in a lot of capacity, so that is not a good look. On the earnings call last night, CEO Sanjay Mehrotra noting this is the most severe industry imbalance in the past 13 years. Some of these analyst notes out this morning have been absolutely vicious. They do not see any improvement in Micron's profitability, not next year, but 2024. That is a long, long way from now. But again, I mentioned Mehrotra, and this is just a bad job by him, I think, throughout this year, forecasting his business. And I understand PCs have been under pressure, demand has been under pressure, supply chains have been tough, but this is a company that's served up, I believe, 5 warnings in a row, and it's just been an awful job of that team. Awful.
Yeah, and I mean, in what you were saying, and you mentioned 4 of the 8 things that you had to say, so I'll try and piggyback with the other 4 things that I think you were about to say. Number one, that long-term compound annual growth rate that you mentioned a moment ago, and the production that comes along with it that they're going to be ramping down as well. They slowed the DRAM production ramp. They're also going to now be looking out beyond for the NAND nodes as well, slowing and delaying some of that production given the new demand outlook that they're looking at right now. And so all of that considered, you've got one on the production side. You've got a second on the employment side. They're cutting bonuses. They're suspending the 2023 bonus company-wide, in addition to that 10% staff reduction that they're making. And then they're also going to have some other operating expenses cut as well. And so where does that really hit on the ability to, when demand does come back, be able to meet that? Because now it's just a question of, all right, not just managing through the headwinds that they're facing, but then also seeing a vision towards the end of it so that they could meet that demand with some supply on the other side of this too.
And those headwinds you mentioned, Brad, they seem to be getting worse. And I love that Micron is usually the early ones to report because they offer great clues into some other industries. On the PC market, they're looking for, Micron said last night, unit volume to decline in PCs by a low to mid-single digit percentage versus 2019 next year. So PC market under pressure has me wondering about companies like an Intel or Dell and HP. How will they fare next year? And also calling out industrial markets that are continuing to soften in the first quarter, which is pretty interesting.
Yeah, all of it very interesting, and we'll see what it does mean for the other chip makers and for the industry more broadly. We got to get to one more thing, a bonus thing this morning, if you will, and that is AMC. The company announced it will raise $110 million of new equity capital by selling its APE units to Antara Capital at a weighted average price of 66 cents per share. And the move's an effort for AMC to remove its long-term debt off its books and potentially improve profitability. Couple of things to mention here. Where the stock is trading now is its lowest going back to January 25th, 2021. That's just before it had its first big meme surge. So that's observation number one. Observation number two, man, for a company that portrays itself as really being oriented toward retail investors, what a gibberish jargon of an announcement related to this. It is very hard to parse out how exactly this complex transaction is going to work. And it's not very shareholder friendly.
Sure, I'm so proud. I think I'm rubbing off you a little bit. Give me a fist bump.
Thank you very much. I will say the APE shares, those other shares, right, that are tracking, they're flying right now, even as AMC is plunging.
I'm gonna have a tear coming tomorrow. I love that.
What'd I do?
It's really good because you're right. This is a very complicated thing. And if you're at home and you've been trading in AMC, the bottom line is this. Here's a company I think that is very focused on reducing debt and getting very creative to help its bottom line in any way it could in what is a very challenging, I think, movie theater environment. This, at its very basic level, will reduce the debt on their balance sheet, bring down interest expenses, and then maybe next year profits will improve just a little bit more. But I think they're lowering their interest expenses by $10 million. But a very clever transaction and one that, look, we have to dig more into. It is very complicated.
Right, and it's $100 million that they're looking to reduce their outstanding debt by as a result of this deal, too. So we'll see exactly where the APE shares continue to move on this. Yeah.
This also, by the way, includes a reverse split of the AMC common shares at a 1-to-10 ratio. So a reverse split effectively means like it's a consolidation of shares. So it's 1-to-10. So that means if you have 10 shares, you'll end up getting 1 share.
You usually see this with stocks that are under $5. It just helps visually improve the stock price. Of course, it's not impacting the valuation of the company. It just visually improves what it might look like. I'm just trying to break it down. It's complicated stuff, guys.
It is indeed. Well, a big transaction, at least for Antera Group as well, and AMC and the ape shares moving on this.
Real quick, I'm glad you mentioned Antera. We did not mention that.
What is Antera?
And they are focused, the CEO or founder of that company focused on distressed situations. So a lot of background in that, which is also a nice, interesting wrinkle here, I think.
All right. Well, for those that are booking tickets on AMC or perhaps holding on to some ape shares, a big day ahead for you to be tracking the stock movement. Coming up on the other side of this, why our next guest is maintaining his position on a moderate recession mid-2023. We're going to speak with an economist from Deutsche Bank next. As many economists have recently began forecasting that the U.S. will sink into a recession next year, 2023, our next guest made that call early on, in early 2022, saying that the economy had significant near-term momentum that would later on lead to market imbalances. That's Deutsche Bank's chief U.S. economist, Matthew Luzetti, who joins us now and still maintains that view. He joins us here in Living Color, live in Living Color. All right, so since you predicted the factors that would lead to or trigger a recession, what would you look towards in terms of the flashing signs in order to lead us out of a recession, or the light at the end of the tunnel, perhaps?
Sure. So I still think there's a lot of uncertainty about the timing of recession. We've maintained a call that it's the second half of next year. And I think we've seen a lot of evidence that I think supports that. In the near term, we just saw GDP getting revised up in Q3. We do still think that there's meaningful momentum. Q4 growth looks okay. I think in Q1, you still have decent momentum. But as you get towards the middle of next year, I think that's where the risks begin to build. I think a key part of that is the U.S. consumer and the drawdown in excess savings that is ongoing. And so I think you'll see a consumer that looks a lot more fragile in the middle of next year. In terms of what we're looking at, I think it's all about the labor market. When does the labor market really begin to show signs of slowing? I think continuing jobless claims are typically our best real-time indicator of recession. As we saw this morning, they remain very low. So you have a labor market with a lot of momentum in the near term. I think that'll keep the Fed raising rates. Ultimately, though, I think that does mean that we have tighter financial conditions as you head into next year and a slowdown in the economy in the second half of the year.
Do you still think there's any chance that we get a recession here where we don't see a spike in unemployment? Or is that, the Fed has said it doesn't think that's going to happen, that we're going to start to see unemployment move towards 4% and beyond.
Yeah, I think when you look at the Fed's forecast, it is as close to recession as you can kind of get.
Without calling it a recession?
Yes.
Yes.
There's 3 officials that actually have negative growth forecasted for next year. But at the same time, it would be the lowest unemployment rate rise that you've ever seen in a recession. Recessions, typically if the unemployment rate rises by 50 basis points, it just accelerates from there. And so I think a key question is, I guess, one, when does that begin to happen? We don't think it really begins to happen until the middle of next year. And 2, how much is the rise in the unemployment rate that we anticipate? We expect that you'll see about a 2 percentage point rise in the unemployment rate, which does sound like a lot, I think. But from a historical perspective, it's actually a quite mild recession. And there I think you have employers that have a lot of incentives to keep labor. We're still a very tight labor market. I think they found out with COVID that it was difficult to go back and then rehire if it was a temporary slowdown. And so I think some of those kind of labor hoarding incentives will probably keep a cap on how high the unemployment rate will rise.
And I was reading a good feature by our Jen Schomburger on the year that has been for the Fed. It's been quite the year. As someone who covers the Fed and what they do, what grade would you give them in terms of performance this year?
Look, I think if a year ago, if we would have said that they would have hiked rates by over 400 basis points this year, I think it would have been absolutely shocking. I think the starting point from where they were offsides in terms of where the inflation was, as many of us were, in terms of how tight the labor market got, how high inflation began to rise. I think they did a really good job this year of right-sizing monetary policy. They caught up very quickly. They took bold steps to take 75 basis point rate increases at 4 consecutive meetings. I think that it has left them in a good spot at this point. It doesn't mean, I think, that the base case is a soft landing, but I think that they have maximized their chances in order to get a soft landing.
For what you're seeing with consumer right now and debt levels, you mentioned a moment ago some of the savings are already beginning to be tapped, but where is debt starting to pile up on the consumer front? And even in the shift of spending right now, we're seeing more consumers lean on credit cards and things of that nature in order to get them through to the other side.
Yeah, credit card growth has been very strong recently, but I think there's important context, which is we're basically catching up to pre-COVID trends and levels that we would have seen. Typically, you want to normalize those debt burdens by income or disposable income. And the consumer really looks good on those metrics still. So the way that I read that data is it's early signs that a good portion of the income distribution is beginning to eat through their savings that they've had. It's meant that they are now needing to fuel consumption by borrowing. I think a key data point is what you've seen with the U.S. savings rate. Over the past 3 months, below 3%, basically record low levels. That's very clearly an indication that savings are being drawn down very quickly. And as we head into next year, I think debt is a more important driver of consumer spending trends.
Matt, as we go into next year and as you have this sort of base case forecast, are the risks more to the upside or the downside? Like the rhetoric feels more downside-y, but which way would you go if you had to guess, like where could surprises come from?
Yeah, I think if anything, the risk to our view is that the recession comes a little bit later, that we don't get it by Q3 or the middle of the year, that the labor market just has a bit better momentum, that good momentum feeds into consumer spending that remains more resilient, and that pushes out the timing of a recession. I don't think that necessarily tells us that we won't have a recession, perhaps by early 2024. I think what that'll mean is that the Fed will likely have to raise rates more, wage growth will be more persistent, price inflation will likely be more persistent, but that the whole manifestation of the recession just takes a little bit longer.
It's been fun following your work all year. Appreciate you always coming on. Happy holidays. Matthew Lozzetti, Deutsche Bank Securities Chief U.S. Economist. We'll talk to you soon.
Thanks so much for having me.
All right, coming up, Under Armour will have a new CEO next year. More on this and the opening bell on Wall Street next. Welcome back. The opening bell on Wall Street just a few moments away. So let's hit a few Yahoo Finance trending tickers on this Thursday morning. Search is over for Under Armour's next CEO after the company hired Marriott's president, Stephanie Lineartz, to take the helm. Really, I would say good hire. Stephanie has been on with us numerous times. She was really instrumental in driving the rewards program over there at Marriott, but also struck a lot of key, I believe, NFL and sports deals for Marriott, which will, of course, benefit her at Under Armour. I know she is very excited about taking this position. She will start at the end of February. Good hire by Under Armour. And really, I think she's going to be missed a lot by Marriott. CEO Tonio Capuano putting out a very classy press release yesterday, just explaining the departure and everything she has meant to the company.
I think this is a great hire for Under Armour. I mean, you've seen within the athleisure space, of course, the more of the companies in the athletic apparel and footwear category that are continually trying to increase their touch base with women and with a core purchaser, especially not just for the household, but especially within athletic apparel and footwear. And we've seen that across Lululemon. Nike shifted their strategy over the past couple years as well. And so for Under Armour, perhaps its next leg of growth can continue to really glean the insights of exactly how it can tap better into some of its core customers and where I think this is also signaling is just another effort to make sure that there are more women who are holding CEO positions in the S&P 500. Only 33 companies in the S&P 500 as of December 2022, which is about 6.6% of the S&P 500, have female CEOs.
Yeah, and as you can see, of the Fortune 500, it's something like 44 right now. It's up 7%, but 44 out of 500 is still not a great percentage. I wanted to mention as well, you guys are sort of echoing what a lot of analysts are saying in terms of this being a good pick. But let's also be clear, she's got her work cut out for her, right? Like, this is not going to be an easy job. You saw what the stock has done over the past year. And Patrick Frisk, the former CEO, cut costs, tried to get things back in shape, didn't quite get it there. And as always, there is the added trick of working for Kevin Plank, right? Whenever you are at a company and you're the CEO and the founder, the chairman, is still hanging around, that does add a little bit of a layer of complexity here. So we'll see how this all plays out.
Kevin is a very big personality. Yeah. He's also still a very large shareholder in Under Armour, so best believe he's going to have influence on this company. But if he wants to start turning this brand around, finally, he's going to have to let Stephanie just take the reins and lead the business like she wants to lead it, and she deserves to lead it, given 25 plus years successfully at Marriott.
Broadly on the whole, hopefully that there are more transitions like this where you do have more representation on a gender basis across the S&P 500, across the markets more broadly, especially as recently as a couple years back, Nasdaq put into place the diversity rule for their companies. Perhaps that creates more of a pipeline going forward.
And it got a lot of backlash for that rule, by the way,
it did, yeah.
Which is amazing to me that is still controversial.
Right.
At this point in time. All right, we've got the opening bell here coming on this Christmas Eve. Are we at Christmas Eve?
Do we have to say that? Christmas
Eve. I don't know.
Why do we have to create all these things?
We don't have to create them.
You just did.
It's the festive holiday season.
I know. Well, tomorrow, we can say tomorrow is Christmas Eve. Why do we have to give it a Christmas Eve or Christmas Eve?
Tomorrow's Christmas Eve.
Yeah.
Eve.
Oh, come on.
It's Festivus tomorrow.
All right. It's the internal security staff over there at the NYSE ringing the bell. All of those folks, I worked down at the NYSE on the floor there, and my previous position for a year or so. And those folks were always very kind,
you did security?
very helpful, Yeah, I did. I did security.
I didn't know that.
No, I didn't do security. I was broadcasting, but the security
okay.
folks, the security folks were always very nice.
They were.
Yes, Brad Smith over at the Interactive there, as we see red on the screen.
Yeah, I still have my badge from the NYSE as well.
Nice.
I'll see if it works and see how well the security is. I'm sure they do a great job.
It doesn't
down,
work.
Brad.
It doesn't work anymore, Brad. It doesn't work.
Exactly. No, they do a great job, and it's been a pleasure getting to know some of the fellows over there and men and women that make that happen on a daily basis. Well, Dow Jones Industrial Average out of the gate here this morning. You're seeing that lower as of right now. We were seeing futures point there, but there you're seeing at the opening across the Dow down by about 0.6%. We're also taking a look at the Nasdaq Composite. You're seeing that lower out of the gate by about 1.1%. Just want to populate this chart for you so you got a good look at what's taking place over the past 2 days. And let's take a look at the past 4 days as well, give you a holistic look at this week as well. Over the course of this week, the Nasdaq Composite Tech Heavy Average is down by about 1.1%. We'll keep a close eye on that. And then additionally here, you've got some downward movement in the S&P 500. That's down by about 0.9%, which is actually pushing us back into negative territory over the course of the past 4 days, so this week. And then additionally, we got to take a look at some of the sectors and see what's popping and what's flopping right now. Well, everything right now looks like it's in the red, actually. We got some flippity flops. The energy sector, that is the best of the worst, if you will. On a relative basis, well, yeah, it's down by about 0.1% here, but of course, bringing up the caboose here, you've got XLK, so technology, consumer discretionary, looks like both of those are bringing up the caboose here. And then we'll just ride out with a quick view of the Nasdaq 100 here out of the gate. Apple, negative territory by about 1.3%. 1.4% in the red is Microsoft. And then Alpha Google, down 1.7% right now. Guys.
Alpha Google. Thanks so much, Brad. Let's take a look at CarMax, all right? It's on a rocky road as it misses estimates. The stock is down about 10.5% amid ongoing pressures across the used car industry. Net revenue seeing a 23.7% slide year over year. The shares are under pressure. You can see their earnings per share really missing by a wide mark there. And the company saying in a statement, vehicle affordability challenges continue to impact our third quarter unit sales performance. So interesting here. We have started to see those prices come down, but it's, not helping.
Yeah, no, things really downshifted in this quarter for CarMax, and the speed of the results really slowed down. You have sales down 23.7% year over year, and we're seeing pressure off of this quarter for the likes of AutoNation. That stock under pressure. You have Carvana, Yahoo Finance's worst company of the year, also under pressure. My read on this is not a good quarter for CarMax, of course. Not necessarily good news for, I would say, automakers or Carvana, of course, which is very struggling. Because if CarMax, a leader in the space, is putting this up, you can only imagine what Carvana is sitting on in terms of a quarter.
Yeah, the brake pads are really getting tested on this one today. That's the best I can come up with.
I'm really rubbing on,
sure.
please.
That's good. I like that one.
Total wholesale units sold, they decreased by about 37%. And that was despite a decrease of about $165 per unit from the prior year's third quarter. But then additionally here, they pointed out one thing that really stuck out to me, which was the profit that they took in. Total gross profit was down 31% versus last year's third quarter as well. And the retail used vehicle gross profit, that was down by about 21%. So if you're in the business of used cars and you're seeing profits decline that massively, especially on a year over year basis, and there still is no kind of end in sight as of right now for when the buyers are going to come back into the used cars or used vehicles, especially given the financing options that are on the table right now, that still signals a lot of headwinds and
yeah, investors they really got keyed here today, Brad. Really got keyed.
They did. Well, another company that we're keeping tabs on here. I didn't even know what to do with that, man. Miller Knoll beating analysts' expectations on the top and bottom line as higher prices offset a drop in orders in the latest quarter here. There you're taking a look at some of the actuals versus the estimates there. It was a beat on top and bottom, as we mentioned here, and for the company in Miller Knoll, this is, of course, where you place your butt for a considerable portion of the day, and you're just sitting on that ergonomic chair trying to make sure that you can get through some of that office work or work from home as well. Some of you have them at home.
This is part of the Julie Hyman trade. You have one of these chairs. How do you like it?
I mean, the chairs are awesome,
right?
Of course. The company is not, by the way, its business is pretty split, and retail is actually a smaller part of its business. It's got its contract business is the biggest part. So, it makes furniture for other businesses, right? But it was interesting in looking into some of the inventory and supply and demand on the retail side. The company said that they had a good cyber week. They did do promotioning, and these are high-priced products, as we were discussing earlier. And they did do some promotions. They said they described that as not aggressive, but did help move through some of that. But they do point out that, the costs associated with holding inventory, right? Which is something we don't always talk about when we talk about inventory. We don't talk about it explicitly. Yeah. Is that you got to put it somewhere.
Right.
You have to move it around, and those things come with costs. So they talked a little bit about that on the call.
Yeah, it could be an interesting 2023 for a company like this. Of course, you have people maybe going back to offices, but do you need new chairs if the office is half full? And then by the same token, you probably bought one of these chairs during the pandemic. So do you need to buy another one? So I think it's going to be a challenging year for this company.
And to your point, and I know this is like everyone, chairs, Brad, Nike, but at the end of the day, yeah, it comes back to restocking. This is exactly why Nike was pushing back on some of the bots that are purchasing and then returning the inventory, because it costs money to store this inventory. And so for Herman Miller, Miller Knoll, what they're calling themselves these days.
Alpha Google.
No, Alpha Google, yes. For Miller Knoll, global retail segment, they're hoping that some of those costs, the handling of inventories and storage, that they're expected to abate, and this by the second half of fiscal year 2023. But they are seeing significant near-term pressure on that front, to your point, Julie.
Yeah, Miller Knoll, remember, because they combined
Yes.
Herman Miller and Knoll, so they still sell Herman Miller as
nice.
part of all of that.
Classy stuff. Look, I was looking at some of their stuff for some mid-century modern a couple of years back. Anyway, it's neither here nor there. Guys, coming up, Yahoo Finance's Jared Blickery going to break down the latest market action following yesterday's rally. That's next. I ended up
Mid-century modern?
Yeah, well, Target has some good men.
Yes, they do.
Welcome back to Yahoo Finance Live this morning, everyone. Taking a look at the major averages here in the U.S. You've got some declines, some catch up on the screen across the board there. We're down by about 1% for the Dow, the Nasdaq, and the S&P 500. A little bit more than that, actually, for the S&P 500 and the Nasdaq. For more on today's tape, let's get to Yahoo Finance's Jared Blickery at the Wi-Fi Interactive. Jared.
Yes, another down day. But as I was saying 24 hours ago, the Santa Claus rally, the 5 trading days prior to the new year, plus the first 2 days of the new year, that doesn't start taking effect until tomorrow. Very technical there, but you can see the Nasdaq underwater for about 1 3/4% for the week. And we'll just check out the Dow here, which has been one of the bigger outperformers of the year, especially as of late. That's up 38 basis points for the week. Just want to show you a longer term chart here. This is going to be of the S&P 500, 2 years. Let me change this to a line graph and just kind of get our bearings here. We peaked. This was the all-time high of the S&P 500 on the first trading day of the year. It doesn't happen always that way, actually almost never, but it's been a slow, steady slog down ever since. And we just sold off of this trend line a couple weeks ago. And that's kind of the mirror image, or at least the mirror story that we have of the 10-year T-note yield. That really took off, started taking off towards the beginning of the year. We had Russia and Ukraine, and plus Chair Powell getting exceptionally hawkish in the second quarter here. But we just bounced off this trend line right here. And so the yields are marching higher. Now, I want to show you the U.S. dollar. U.S. dollar is staying put. It's still below its 200-day moving average. That's a key technical level, and it has clearly fallen out and broken through its downward trend line. Does this comport with the possibility of a Santa Claus rally? Yes, it does. And if it does, we get some help within the commodity sector as well, which we can get to in a minute. But first, I want to check out the SPDR S&P 500 sector ETF showing tech. That's down almost 2%. That's XLK, followed by consumer discretionary and communication services. All of those down 1.5% or more. Healthcare staples, those are the least bad off, but those are defensive sectors. Let me just show you what's happening in some of our leading markets. Basically, only gambling stocks, that's bets, that's in the green right now. We had KWEB, that's a Chinese internet ETF that had been green, that is flipped into red territory. Just want to show you SOX and ARK. Those are that's disruption and chip stocks. Those are the biggest leaders to the downside. If we take a look what's happened this week, we can see a lot of negative price action in there. So let me just show you, as I promised, I was going to get to some of these gold miners and also the gold market. We've seen GLD pick up recently. That is an ETF that tracks the gold ETF, and you can see bumping up against some potential resistance here. I think it's about 1,800 in the gold, 165 maybe in the GLD. And let's just take a look at what's happened over the last 3 months in terms of some of these gold miners and also ETFs here. 20% in silver, kind of off the radar there. So maybe that'll pick up in the new year as well, guys.
And what should be on the radar, Jared, is your morning brief newsletter, because it was superb. I encourage everybody to check it out and give it a read. Jared, thanks so much. Appreciate it. All right, here's something you probably couldn't predict coming into the year. According to Yahoo Finance data, Tesla's forward price to earnings multiple is 27 times. That is now below the 28 times multiple fetched by consumer staple Hershey, reflecting in large part the 60% plus slide in Tesla's stock year to date. Tesla's PE multiple is also below the one found on Yahoo Finance Company of the Year, Costco, at 38 times, or 32 times, I should say. Coming up, is it smooth sailing for inflation to come down? Is it smooth sailing for inflation next year? We'll explore more of this with BlackRock's Wei Li next.
U.S. inflation has cooled in recent months, leaving investors bracing for what's to come in 2023. BlackRock says a new investment playbook is needed and a recession is foretold. BlackRock Global Chief Investment Strategist Wei Li is joining us now. It's good to see you. Happy holidays to you.
Happy holidays.
Thanks. And so what is the playbook? What do investors really need to key in on going into 2023?
As we head into 2023, different from previous year ahead outlook, we're not positioning one set of investment views that are expected to work for the entirety of next year. We believe in an environment of higher macro volatility, of higher market volatility. A more nimble approach is warranted, which is also why a new playbook is warranted. So currently we're still risk off. We have been underweight developed market equities for quite a long time, for the most part of this year, and we have been overweight investment grade, so high grade credit. But at some point, we want to turn more positive. We believe that we would turn more positive, and this playbook points to us turning more positive. But in order to get there, we either want to have a higher risk budget to play with, which will be driven by macro indicators and market indicators, or we see the bad news being priced in fully in markets. So currently, as you said at the beginning, we forecast a recession in 2023. We also forecast earnings contraction. That is not being priced in by equity market, which is why we're currently underweight developed market equities.
What if I don't have kind of a high risk propensity and because my portfolio is on fumes after 2022, where then should I be placing my money?
Well, the difference versus beginning of this year, as we look at the beginning of next year, is that finally income is back in fixed income. So you're getting paid quite handsomely in the short end of the government bond market. You get paid more than 4% without taking duration or credit risk. And for high grade credit, you get paid more than 6% without taking much duration risk, but also, frankly, not much credit risk, which we think is very, very attractive, which is why in the latest outlook, we have pushed further our overweight of investment grade to +2 from +1 on a scale of -3 to +3. And we use a local currency emerging market where we have been overweight for parts of this year, but we downgrade that to neutral in order to fund this further upgrade in local, in high grade credit. So this is how we would kind of think about bunkering down as we navigate recession. And at some point, we want to turn more positive, and that would be either through greater risk budget or through markets pricing in more of the macro outlook that we see coming.
Your team writes in the outlook that equity valuations don't yet reflect the damage ahead. Well, what do you exactly see coming? And then if you do see more damage ahead, do you see new lows for this bear market happening next year?
Well, currently, if you look at S&P 500, it's shy of 3,900, and that prices in a peak rate slightly above 5%. And it also prices in a rate cut being quite aggressively baked in starting Q3 next year. At the same time, you work it backwards, it prices in earnings growth for next year at mid-single digits. So what do we agree with and what do we not agree with? We do agree with the fact that peak rate is likely going to hit a 5.25%. That is our forecast, but we do not see rate cut cycle starting next year. In fact, we see it starting in 2024, but even then it's more muted than what currently markets are pricing in. So that's one aspect of market pricing that we would lean against. And also we see US equity market in terms of EPS growth for next year at -6%. And that stands in contrast to the current consensus and market pricing, which is why we would lean against the equity rebound that we saw at various moments, even just this month. In terms of lower lows, but actually with S&P at 3,600, which was the summer lows, that would be ballpark reflecting this not deep recession that we see coming, and that would be an indication for us to want to turn a bit more positive if we get to that level.
So we've been talking mostly about the U.S., although you did mention developed markets versus others in the world. But I do wonder, when you look around the globe, is there any market that you think will be more resilient in the coming year, or that is sort of an overlooked investment possibility?
Well, at this juncture, we talked about asset classes, and currently we have a preference for credit over equities. But when we look at regional, global kind of nuances, I would say currently we're underweight developed market equities, but we're actually neutral emerging market equities. And that is in part reflecting the fact that as we head into 2023, different from this year, China is going to reopen. China is reopening as we speak versus 2022, where China has been in lockdown for most part of this year. So that momentum is somewhat behind our current preference for emerging market versus developed market equities. And also, in addition to the China story, dollar, right? So far, what caught investors by surprise in 2022 is the ferocious strengthening of dollar momentum. And as we head into next year, the interest rate differential, it's there, but the gap is somewhat closing with the ECB, with the BOE also catching up really quite quickly. And at the same time, if you think about the broader environment around inflation is coming down next year. We do not see dollar strength persisting in 2023, and that would be somewhat supportive of emerging market as well. Now, I said supportive and I said preference for emerging market over developed market, but given our broadly risk-off stance, even our preference for emerging market equities is currently a neutral allocation in portfolios.
Right. Definitely not pounding the table on that one. Thank you so much, Wei Li, BlackRock Global Chief Investment Strategist. Thanks so much. It's been a pleasure to talk to you this year. We'll see you in 2023.
Looking forward to that.
Thanks. Coming up, Citi is shelling out reasons that Apple may be a buy in 2023. Saz has got the details next. Apple shares, they're down over 20% this year, but Citi analyst Jim Suva has 6 reasons why the stock will rebound in 2023. It's no surprise that this list caught the attention of Mr. Brian Sozzi. That's where we find his take today. Talk really quickly. Six reasons.
Damn right, a list is going to catch my attention. I love me some lists, especially in Apple Research Note and on a stock that our universe or ecosystem here at Yahoo Finance absolutely loves. Let me tick through these. Why Jim Suva, longtime tech analyst, is bullish on Apple into next year. And I'll try to make this quick because I really want to get to number 6 here on this list. First up, India. Suva sees just rising wealth or rising incomes in India being a key driver for Apple's business looking out next year and even beyond next year. iPhone sales growth, he estimates that will return to growth in the middle of next year. Things will start to improve there. That is good. Services sales upswing. Same thesis as he is seeing in the iPhones. He expects services sales, which have decelerated over the past 4 quarters, to pick up steam again next year. Those new products. Suva is not alone in here, expecting Apple to launch an AR, VR, some type of headset that takes on Meta's Oculus. And then number 5, regulatory risk overblown as it pertains to the App Store in Europe. And number 6, which I really wanted to get to, is the cash giveaway, because you see Apple stock down about significantly this year, and I think this is the market forgetting how much cash this company in fact has on its balance sheet. Suva sees Apple potentially spending $110 billion next year in total shareholder returns, meaning stock buybacks and share repurchases. He estimates alone Apple could come back and repurchase almost 5% of its outstanding shares this year. That is a lot. And you look at Apple's stock price there on the chart, you would argue, and as Suva is arguing, with a $175 price target, that none of these things are priced in, especially that cash giveaway. And my take is really staying along those lines. It is hard to envision, given the key drivers in Apple's business, that this stock is down again next year. And I'll add the caveat, we're not picking stocks here. This is not me recommending Apple shares, but just given the drivers in its business, even if we do get a moderate recession, you're now seeing Apple shares trade about 20% discount to its historical P/E ratio. Just given that discount and the drivers, it's hard to see them having another bad year.
All right, I knew you were doing Apple today, so I wore my Tim Cook outfit here.
Very Tim-like, very Tim.
Guys, coming up, we're going to break down the latest market action with the founder of 22V Research. That's coming up next.
What holiday season? We're still crushing it here at Yahoo Finance. I'm Brian Sozzi alongside Julie Hyman and Brad Smith. Those holiday vibes are starting to descend a little bit onto Wall Street, though. All three major indices right now are in the red. You're seeing the Dow down over about 370 points now, S&P 500 and Nasdaq also in the red. Now here's what's on tap this hour. Inside the big holiday freeze, investors in airlines and other storm-related companies are on edge ahead of a major cold snap ripping across the country ahead of the holidays. We'll have the latest. And the year in big cap tech. Yahoo Finance tech editor Dan Halley is here with a look at some of tech's most brutal stock moves of this year and next year for Netflix. Yahoo Finance media correspondent Ali Canal is here with a preview on what's on tap for Netflix next year. But first, Brad, I see you playing at the Wi-Fi Interactive right now.
I am indeed playing at the Wi-Fi Interactive, doing a little touchscreen magic here, and the Dow Jones Industrial Average is where we begin checking in on the markets 32 minutes into today's trading session on this Festivus Eve. The Dow is signaling exactly what it's upset about, and it's down by about 400 points as of this point in time. Nasdaq Composite, you're seeing that down by about 2% right now. Over the past 2 days, that's down by about 0.5% in aggregate here, and over the course of the past 4 days, so this week, that's really racking up some declines at this point for the Nasdaq Composite, down by about 2% over the course of this week, and then the S&P 500, you're seeing that down by about 1.5% here. So some of the losses have certainly accelerated here on the day. We'll give you a look at the intraday chart, and we're just about at some of our intraday, if not at our intraday early morning lows here. So we'll keep close tabs on this to see exactly what takes place. Of course, there's going to be some low volume over the final trading sessions of 2022, as many traders and one of the guests that we had earlier said that they were about to step away from the desk, take some valued vacation time, and so we could have light volume and that increasingly contributing to some volatility as well, perhaps in the near term. Let's also take a look at some of the movement that we're seeing in the Nasdaq 100 here. Just want to get us back on over to that tab. The touchscreen has betrayed me, so you know what? I'm going to go back here and let's take a look at some of those travel names to see exactly where things are moving around here. And this is over the past 3 months, so let's put this intraday. As Ozzy was mentioning a moment ago, we've got some cancellations that are really starting to add up for airlines right now. You see UAL down by about 1.6%. AAL, American Airlines, that's down by about 2.25% here on the day. And then additionally, just checking in on one of the other airlines as I was looking for Delta. Delta is down by about 1.2%. We'll have more of a conversation on that later on in this hour, as Ozzy mentioned a moment ago. However, getting back to one of the major items that we're tracking, our next guest says he doesn't see a reason for financial conditions to tighten much more. 22V Research founder Dennis DeButcher joins us now. Dennis, walk us through your thesis. Why do you believe that financial conditions won't tighten much more from here?
Yeah, so it's a good question because the economy is clearly slowing. So when you look at underlying demand, and the New York Fed has a great index of this, their weekly economic index, you've seen a significant shift lower over the last couple of months. It has been decelerating for a while, but now you've seen a significant shift lower. And as demand growth moves aggressively below trend, you should see some loosening up in the labor market. So the question now is not whether or not financial conditions need to tighten more or less. The question now is what's the impact on the economy longer term, and will we be able to avoid a hard landing? So I don't think financial conditions are going to ease, by the way. I just don't think they're going to tighten. They're going to stay around this level. And as they stay around this level, you're going to see the economy continue to slow fairly aggressively. We'll see if we go into, a recession, hard recession, whatever. And now it's really about the E. And it's about how that plays out over the course of the year.
And something you pointed out, Dennis, in your daily note is that even though we are seeing all of this commentary around the economy, the consumer confidence, the number that we got yesterday from the Conference Board, was actually pretty darn good. And that confidence is tracking more with inflation than it is with the overall economy. What are the implications of that for consumer spending and then for the economy going into 2023?
Yeah, confidence has a very poor record of actually predicting spending. And so one of the things we noticed is that over the last year, as the economy was ripping, right, you had fiscal stimulus, then you had credit creation, you had very strong spending numbers, and consumer confidence plummeted because inflation went higher, which is a long way of saying people hate inflation. So now you're seeing inflation expectations come down, confidence increase. But as the unemployment rate starts to move higher, you could be rest assured that people will stop focusing on inflation and start focusing on jobs as a reason to be upset. And that's going to have the biggest influence, meaning the unemployment rate, on actual spending. So demand growth shifting lower, the unemployment rate moving higher, the labor market in general just loosening up is going to lead to significantly lower retail sales over the course of, certainly the first part of next year.
Dennis, are the lows for this cycle in the markets in?
I think the odds are that they are. I mean, I would say my confidence in that is not, 100%. I would say maybe 60% odds that the lows are in. I think we're more or less in a range of kind of 3,800-ish on the downside, 4,200-ish on the upside. I'm not excited about being short the market at 3,800, just from a money-making opportunity point of view. Yeah, clearly it could go lower than that. But unless you have a lot of confidence that earnings are going to be substantially lower than what the buy side is expecting, and I don't think that the odds of that are high, it's really tough to be too negative around the 3,800 level. And I would say, when I say the buy side, forget the sell side, because everyone talks about the sell side estimates. When we survey investors, the immediate expectation for earnings next year on the S&P 500 is 220. So a lot of the negativity on earnings, I think, is factored in. It's just a matter of you get significantly below that.
Dennis, with the thesis that you've laid out, what is your big idea, your top idea for investors who are looking for solid returns in 2023?
Yeah, good question. Early cyclicals relative to deeper cyclicals. The economy is going to slow. And when I say early cyclicals, that's going to be tech discretionary over things like industrial materials and energy. So that is the idea over the course of the year. Now, I'm not a total idiot, hopefully not. So it's going to be difficult for that to work potentially over the first 3 months, because we're going to be going through the worst part of the slowdown in economic growth. But if you look over the span of the year, I think early cyclicals have a very good chance of outperforming deeper cyclicals. And then I would say cyclicals in aggregate will outperform defensives. So your staples, utilities, healthcare, REITs, which have extraordinarily high valuations, both on a relative and absolute basis, are just way too expensive unless you have a very hard landing in the economy. We're not calling for a very hard landing.
What are you most worried about going into 2023? Is it the prospect of maybe a hard landing, or what are you sort of keeping an eye on?
I guess what I'm most worried about, it would end up in a hard landing. What I'd be most worried about is being dead wrong on spending growth the next 3 months and the Fed having to do a lot more. So I made the point earlier that financial conditions don't necessarily need to tighten a lot more from here. But if it's proven out that they do, because spending growth continues to accelerate or remain too strong, and this is very important, the labor market doesn't loosen up. So maybe you see claims start to move back down. Maybe you see the unemployment rate not move higher. It's clear that the Fed wants the unemployment rate higher. If that were to happen, then you could expect the federal funds rate maybe to go a little bit higher. And the federal funds rate has to go a little bit higher when the economy is already slowed. I mean, the odds of a harder landing, increase. So that's the biggest risk in our view.
22V research founder Dennis Tepper, always good to see you. Happy holidays.
Yep, good to see you. Thank you.
Tesla is slated to report its fourth quarter delivery and production figures right after the new year. Ahead of that, Deutsche Bank analyst Emmanuel Rosner is slashing his estimates for deliveries, sales, and profits. Rosner sees fourth quarter earnings coming in at $1.05, below current analyst forecast for $1.24. Rosner says the cuts reflect some economic weakness in China, as well as the postponement of deliveries into the first quarter in the U.S. from some consumers in order to benefit from the Inflation Reduction Act's EV incentives. Coming up, Netflix is investing big in a new production hub. Julie's back with a look at today's top headlines next.
Some other headlines now that we're watching on this Thursday morning. A surprising move from Tesla. The company is now offering U.S. consumers a $7,500 discount on the Model 3 and Model Y vehicles. That's double what it was offering earlier this month. This latest discount coming just days after the U.S. Treasury Department delayed restrictions on electric vehicle incentives until March. That means Tesla and other U.S.-made EVs could qualify for the full $7,500 credits temporarily. Now, the move is unusual for CEO Elon Musk, who enforced a no-discount policy for years and comes after Tesla warned it will miss its delivery target this year. Hundreds of Tyson employees are choosing to leave the company as it moves to consolidate its offices to Arkansas in the next year. That's according to the Wall Street Journal. Back in October, Tyson announced that it will be shutting down its offices in Chicago and North and South Dakota. Workers at those offices had until November 14th to decide if they would relocate to Arkansas or leave the company. The anticipated employee departures come at a time when beef profits are under pressure. It's worth noting Tyson's beef business reported soaring profit margins over the past 2 years, with strong consumer demand pushing meat prices higher. And Netflix unveiled its plans for one of the largest production facilities in the world, landing in Fort Monmouth, New Jersey. The company bid a whopping $55 million for the 293-acre location. It was a former military base. This adds to Netflix's existing studios on the East Coast in Brooklyn, which the streamer opened in 2021. Exact titles to be filmed at the new hub still to be determined, since the project not expected to be completed until 2027, Saz.
Oh, Julie, who said Jersey wasn't cool? Not this guy, and clearly not Netflix. All right, slowing growth and rising competition in streaming from Paramount and Disney has sent shares of Netflix down more than 50% this year. So will next year bring a recovery for Netflix shares? Yahoo Finance media correspondent Ali Cannell is here with a preview on all things Netflix next year. Ali.
Hey, Saz, good morning. And I agree. I am pro New Jersey. I'm here right now. Love Jersey. Go Netflix. But yes, Netflix has faced a lot of headwinds this year. But I will say that the stock is up more than 65% over the past 6 months. And that's largely due to optimism surrounding its ad tier that debuted in November, along with increased competition. Increased improvements on the content side that could decrease churn as competition intensifies. But some analysts are not that convinced. We have a new note from Laura Martin from Needham, and she highlighted her top concerns for 2023. She said slowing subscriber growth, increased pressure on average revenue per user. That's a key financial metric for Netflix. That will pressure the stock and its revenue targets in 2023. She lowered her full year 2023 revenue estimates by 7% to $33.4 billion, also lowered expectations for adjusted EBITDA and GAAP EPS. Another concern here, although analysts are predicting that the long-term game is what you need to watch, is advertising. We've seen recent headwinds about Netflix not meeting those viewership targets, a lack of popularity for the ad tier, and the bull case for 2023 really relies on this ad tier being successful. So if they fail, that's going to be reflected in the stock price. And then finally, the fact that we're seeing increased regulatory oversight could also be a headwind. We saw the FTC reject Microsoft's bid to acquire Activision Blizzard, and Martin argued that that hurts Netflix shareholder value in two ways. Number one, she previously said that Netflix could potentially buy Netflix, but that Microsoft could buy Netflix, but the FTC lawsuit makes that possibility unlikely. And then number two, Microsoft could be distracted by this FTC lawsuit from those ad commitments for Netflix's ad tier in 2023. So all potential issues to look out for as Netflix looks to climb back from those year-to-date declines.
Ali, while we have you, Netflix is also entering into the fitness space. What can you tell us about that?
Yeah, very different than what we've seen from Netflix on the content side, but beginning December 30th, so just in time for all those New Year resolutions, Netflix will be launching 30 hours of workout videos from Nike Training Club, and there are plans to launch more videos throughout 2023. For me, this is another push to nab subscribers, lure them away from competitors. We've seen a lot of these streaming giants play with live events, play with video games, workouts. Why not? Everything just seems to be on the table when it comes to acquiring paying users and increasing profitability. So we'll see. I don't know. Sazi, I feel like you're going to be doing one of these Netflix workout videos.
I already did 12 of them. I already did 12. I'm ready to go. Love them.
Perfect.
Big fan.
Amazing.
Yeah.
I
Are
love
they
it.
actually out yet?
No.
December 30th.
No. I've done them all in my head already.
Allie, thanks so much. We're going to do them when they come out. Appreciate it. That's Yahoo Finance's own Allie Canal. And coming up, get your winter snow tires ready. That storm that may have a heavy, how could you do it if it's not even, it's like a storm that you're shoveling for that hasn't even arrived yet. A winter storm that may have heavy impact on your holiday travel plans. We're going to discuss.
That's a great snowplow.
Roughly 11,000 flights facing delays today and about 4,000 canceled, according to flight tracking service FlightAware. This as a once-in-a-generation winter storm wreaks havoc across the central U.S. region on its path to the East Coast. For more on the impact of the Arctic air, let's bring in AccuWeather lead and chief meteorologist Jonathan Porter. All right, John, it hasn't been looking good for some of the forecasts that we've seen thus far. I don't expect you to have any good news for us. So just as we're bracing for what you have to tell us, we're also bracing for this storm. What do we need to know?
Well, good morning. I wish I had better news, but this really is a bitter blast of Arctic air originating direct from Siberia, all the way channeling through Canada and plunging across the central and eastern part of the United States in the coming days. And it is going to be accompanied by an intense storm, in fact, a blizzard developing in the Midwest, which is going to help drag that cold air even further south and east. And as you mentioned, the big issues here are the wind, the blizzard conditions, a flash freeze that's going to happen with these rapidly falling temperatures, and big time travel problems. In fact, I'm afraid it's a travel nightmare here over the coming days.
Well, anytime you drop Siberia, you know it's probably going to be cold and not good for us travelers here. But when do you see this ending, and what is the longer term outlook as we approach New Year's?
Well, the good news on this is when you look at this as compared to other cold outbreaks, it's not going to be particularly prolonged across much of the country, except for perhaps the northern plains and the northern Rockies, where the cold will be most persistent. But it's going to get cold in a lot of places, and especially in the southern part of the country, start to rebound here as we head back Christmas Day and the time period after Christmas. So that's some good news. While gusty winds and heavy snow continue downwind of the Great Lakes, feet of snow in the Buffalo and Watertown, New York areas into the Christmas weekend.
So obviously you and your colleagues and peers have been warning folks about this. So there's some lead time here, not just for individuals traveling, but for companies, right? For the airlines, et cetera, for businesses maybe that want to shut down. So the timing of this happening right when Christmas is approaching and sort of how we've managed around the storm, what is the overall business impact going to be on travel, et cetera?
That's a great point, and we have been warning about that here at AccuWeather for over 2 weeks now about the risk for a unusual surge of bitter cold to envelop the central and eastern part of the country and the big blizzard. So there has been advance notice. Of course, here at AccuWeather, we work with more than half the Fortune 500s and thousands of other companies giving them weather insights specifically for their business operations. So the weather information has been there. Now we'll see how companies and various types of governments react to it. Of particular concern is the travel industry, as you mentioned. Here at AccuWeather, we've been forecasting the risk for over 5,000 flight delays and cancellations each day over the coming days, because it's not just one part of the country. These are big hubs, Chicago, Detroit, and then over to the East Coast, although it's not snow, it's gusty winds and heavy rain. And these are the kind of problems that can really quickly mount and cascade across the country. Of course, the other thing we're monitoring very closely is the status of the Texas power grid, and the risk for power outages. They're always a concern when we're talking about air temperatures in Dallas in the single digits, but AccuWeather real field temperatures, including the wind aspects, a cloud cover, a variety of other factors, minus 10 degrees Fahrenheit in some places. So this is a big deal across much of the country.
Jonathan, I know you're a meteorologist, and so I don't expect a full-on kind of analysis of the economic impact, but is there a general dollar figure in the past that you could point to for a storm of this magnitude where you remember, and it sticks out vividly, how much of an economic impact there was and how that correlates or analogous kind of comparison to this storm?
Well, that's also a very important point, and that's something we actually do here at AccuWeather. We have a whole team that analyzes very uniquely the impact of weather on the economy and what type of damage and economic loss can occur. In this case, it's going to likely be in the billions, because we're going to be talking about all of those travel cancellations and delays. And think about all the impact it's going to be, especially to that last mile delivery of Christmas packages, all those last minute Christmas packages. That's why we've been warning about this so far in advance, so that people are prepared and can make the very best decisions. This one looks like it's going to be certainly billions in terms of overall impact. Bill, a little bit less, it looks like, probably than, for example, the big cold wave, the historic one in February 2021 that caused all those problems in Texas, probably because although this is going to be intense, it won't be as long lasting.
Jonathan, I'm going to go self with my last question. If somebody out there who might be viewing was flying to Ohio, would you tell them to go to the airport here in New York, or to just stay home and try to rebook somewhere else?
Well, I heard somebody we know might be traveling to Ohio. I just had some information about that, right? My advice is to go early, and if you can get ahead of this, the better. And in the East Coast, conditions are going to be deteriorating as we head through the day today, from rain developing, the wind picking up, those ceilings coming down. So that causes airport operations to slow down. And then we're also going to be dealing with that big flash freeze tomorrow. And I want to point that out. These are some of the most significant temperature drops that people may see in their lifetime occurring across the central and eastern part of the country. Take a look at Cheyenne, Wyoming. Yesterday went from 43 degrees to minus 43 degrees to 0 in a matter of 30 minutes. That is a significant temperature plunge, and those kinds of significant reductions, quick reductions in temperatures, are heading to the East Coast. That's why we're concerned tomorrow about conditions quickly becoming icy, especially on secondary streets and sidewalks, and that's going to create a huge mess at the airports.
Yeah, we were talking this morning about the movie Day After Tomorrow, where the flash freeze comes to New York City, and everybody has to hide out, and it's very dangerous. So If that's my guide, I'm definitely going to be hiding out. Brad, maybe you should leave set now
get out
and
of here,
just
man.
go to the airport.
I think the sooner you can get going, the better. Again, that's the advice that we've been providing and recommending people to frequently check the AccuWeather forecast. We're updating it minute by minute here as the situation evolves.
Jonathan, real quick, are we getting any snow here on the East Coast? Any snow? I want to take out my sports car on Christmas.
All right. Well, here's the good news. Maybe just a few flakes of snow as this particular storm ends, but the big snow impacts are going to be near the Great Lakes.
Sounds like perfect weather to me.
No, there's going to be ice, man. I'm sure that thing does not have front-wheel drive or all-wheel drive. You're in trouble. All right, Jonathan Porter. Well, we could talk about this all day, obviously. Jonathan Porter, AccuWeather's chief meteorologist and lead of AccuWeather. Thank you so much. Appreciate it.
Happy holidays and stay safe.
Thank you. You too. And another story that we are watching right now, reported by the FT today, Carlyle Group is struggling in its search for a new CEO since the abrupt exit in August of its chief executive officer. Unease settling in about the future of the company as its growth falls behind compared to its competitors. We're showing Kyu-Song Lee there, who was that CEO who stepped down. And according to the Financial Times, the partners at the company, the existing partners at the company, maybe have made it a little trickier to find a new person to lead the company. We're talking about David Rubenstein, William Conway, and Daniel Daniello, who, they're the ones who control the company. They want to see it run in a particular fashion. And as we were talking about earlier with Under Armour and Kevin Plank, for example, it's tough to come into a company when you have those big personalities looming over.
I'm still cold after listening to Jonathan Porter. I'm really, I'm just freezing just thinking back. But interesting situation here. A name floated by the FT is Nasdaq CEO Adena Friedman. Now, she was the former CFO of Carlyle. And you've talked to her before. I've talked to her, Brett. I think she reflects back very fondly on her time at Carlyle. She went there before taking that CEO role at Nasdaq, and I think she learned a lot of skills. Seems like a natural fit. The FT saying she didn't want the job. Yeah, she was actually a boomerang at Nasdaq, and I remember working there at the time when she had taken on the helm as the president and chief operating officer in that boomerang capacity, and then come and taken over as the CEO role after Bob Greifeld departed. But at the end of the day, for what Carlyle is signaling here and what is really taking place, I think we've seen in a few companies there have been a succession planning issue. We've seen that not just at a privately or a private equity company like Carlyle, but you've also seen that in publicly traded companies like Salesforce, where there's been this revolving door. You've seen that within Disney, where we've seen now Bob Iger continue to come back into the role, and the power jousting that's also taking place, or the tug of war there. Within a few core companies, Disney, Salesforce, Carlyle Group even, and just the succession planning that is so key to some of the publicly traded companies as well in how investors evaluate them. I think that's what's extremely critical, and for Carlyle, how they may evaluate some of the companies that they're looking to invest in too. One other interesting revelation from this FT story is that BlackRock looked at Carlyle as a potential acquisition candidate and then decided ultimately it did not want to do so, at least not right now, even as BlackRock does get more into alternatives, wasn't willing to go because of the optics. I like what the FT, a little wrinkle in there, saying it would be hard for them to acquire a business where executives are making just tons and tons of money, really seemingly every single day. Yeah. All right. Well, coming up, Yahoo Finance tech editor Dan Halley joins us for his analysis on tech's disaster trades of 2022. Stick around. To say the tech industry's biggest players had a rough year on Wall Street is an understatement as firms deal with rising interest rates, inflation, and supply chain issues. But who were the overall worst tech stock performers of the year? Yahoo Finance's Dan Halley has been doing some digging and joins us now. Dan, take it away.
That's right. We had a not great year for tech stocks on Wall Street. The winners we went over yesterday came in with negative year-over-year percent growth, so declines for the year. But now we're looking at the worst performers. These are the ones that were just really down in the sub-basement of things. And as you could see, we gave them participation trophies. I don't think we should give them anything, but we did. So let's start off firstly with AMD. They, like other chip stocks, ended up having a tough year because people just simply stopped buying computers. They bought all their PCs that they needed during the pandemic. Nobody needs a new computer 2 years after the fact, or even 3 years after the fact. They usually last about 5 to 7 years. AMD, Intel, Nvidia, they're all struggling with this at the moment. The problem with AMD, though, was that year over year, their client segment was down 40%. That's how many people were buying their PCs, their different devices. So their revenue was down as a result. And so they really were just one of the big laggards here. Then we have, after that, obviously, Tesla. We can't talk about Tesla, though, without talking about Elon Musk and Twitter. Firstly, the company itself suffered from issues, whether that's FX problems, whether that's the increased price of materials. That has a lot to do with it. But then as we saw the year drag on and we saw Elon Musk eventually go ahead and buy Twitter after that, will they, won't they kind of rom-com setup that we had in the earlier part of the year. Now he's in it and he's seemingly fully focused on it. And so a lot of shareholders are wondering, where's his focus on Tesla? Is it there or is it not? And so we're seeing the share prices of that absolutely get demolished year to date. And then finally, this one was the fun one to write just because it was so bad, is Meta. This company has seemingly been just tripping over itself since they renamed to Meta from Facebook. Mark Zuckerberg is dead set on turning the metaverse into, I don't know, a new world where everybody, WALL-E, where everybody just sits there in their chairs and doesn't really move. That's kind of what he's envisioning to a degree. He's dumped $10 billion into it in 2021. He's going to exceed that in 2022 and continue to grow that in 2023. He says the company says it probably won't be profitable as far as the overall picture for the company for maybe 5 to 10 years from now. I've talked to experts who say the metaverse isn't going to be a thing at all, or that it'll be 15 years from now. In addition to that, they're still struggling with the privacy problems that Apple's iOS changes have brought along. So it's the slowing ad market on top of that that has really just crushed their revenue. At one point, we talked about how Facebook itself was losing some users. They're not doing well with teens. I mean, I could just go on and on and on about the various problems that Meta had, and you can see that reflected in its stock price for the year. And looking forward, some folks are saying, well, the ad market will rebound. Sure, but that doesn't mean that we'll get those teens back. TikTok is where it's at for them. Instagram, sure, but TikTok is eating Instagram's lunch. They're playing catch up the whole time to try to get with TikTok. So I don't know if Meta is going to return to the place that it once was or once stood at. Tesla and AMD, they seem to have a better chance at this point, although I guess you can never really count out Mark Zuckerberg.
Dan, while we have you, which of these companies is best positioned to have a comeback perhaps in 2023?
Yeah, I think honestly, between the three, it seems more likely Tesla, right? Because AMD is going to continue to struggle with people. You don't need a new computer every few years. I'm not going to, and I'm a dork, and I buy new gaming laptops or new gaming PCs, more often than the average person. You don't need that.
I don't.
You get a computer, 5 years. Once the fan starts making weird noises, then you're like, all right, maybe I'll go and buy it. So that's a problem for AMD. What's saving them, though, is the server side and people buying those game consoles. The PlayStation and Xbox, those are AMD powered. So people buying those, that helps them, and the server side helps them. The client side, it's not going to do well, I don't think, for some time. Some experts I spoke to said it's going to be years before it really gets back to the kind of growth that they were seeing. Meta, like I said, I mean, what else can you say outside of, they're dumping this money into what very well may never pay off. The headset space is going to be big because of Apple jumping in there, but the idea that you're going to be in this metaverse world talking to people, I've seen the business use case for it, and it's not interesting. If you hate meetings, you're not going to like meetings because you're floating around with people that are dressed as dragons and robots. Nothing about that sounds appealing to me. So, yeah, I think out of the three, Tesla's probably in the better position.
All right, Yahoo Finance's Dan Howley with a look at some of the worst tech stocks of 2022. Thanks so much, Dan, for wrapping this up for us. And also here, switching gears, speaking of tech, YouTube striking a deal to secure rights to the NFL Sunday Ticket franchise with an average payment price of roughly $2 billion a year. That's according to the Wall Street Journal. The addition of Sunday Ticket would boost YouTube's streaming efforts as the company looks to broaden beyond advertising sales and into subscription revenue. For more on this, we have Yahoo Finance's Josh Schaefer. So Josh, what do we know so far about this deal?
Yeah, Brad, so you kind of hit the headline there as far as $2 billion a year is what the journal's reporting that Google is going to be spending on this for YouTube. And really the key for the deal here is it's an add-on to YouTube TV. So if you're already paying that $64.99 a month, you have to pay more to get Sunday Ticket. Or you can get it a la carte, so you don't have to be a YouTube TV subscriber. So you could see YouTube sort of add subscribers in that way. And I think that that's sort of an interesting add-on to this. You don't have to be a YouTube TV subscriber. But really to kind of explain what Sunday Ticket is, because this is much different than what Amazon got, right? NFL Sunday Ticket is for out-of-market games. So say if you're an Eagles fan in New York and you want to watch the Eagles every weekend, you normally only get the Giants and the Jets. This gives you out-of-market coverage. So you're going to have NFL fans that come to YouTube TV every Sunday now and want to come back week after week. Amazon got something a little bit different, right, with that one game a week, and it's not necessarily your team playing every week. From a stock perspective, I don't think you're going to see you haven't seen too much of a move this morning, and that's sort of what analysts have been telling us all along with this deal, right? You're talking about a company that does over $200 billion yearly in revenue. A $2 billion spend is not necessarily something that analysts and people are going to start freaking out about, but it is going to be interesting to watch. Do they ever turn profitable on this? Or is it just to bring more people to YouTube TV, right? Because $2 billion a year for this service, they're certainly not making that back in subscriptions to NFL Sunday Ticket, and I don't think they're going to make it back in ads either. So how do you sort of start to turn a profit on that over the next couple of years, I think is interesting.
What does it mean for the traditional broadcast networks? Here you have another streaming player, along with Amazon now broadcasting games as well, chipping away at their dominance.
Yeah, so I was talking to the 49ers president about this, Al Guido, and he's also the CEO of Elevate Sports Ventures, which oversees multiple different leagues. There's sort of an advisory firms. He's got a good pulse on all of the different deals. And he said that's probably one of the biggest takeaways from this. When you fast forward, 5, 6, 7 years from now, when those CBS and Fox deals finally expire, you now have big tech having 6 or 7 years of seeing what the NFL can do for them. What if Amazon and Google, and maybe Apple then sees what it's done for Amazon and Google and wants to get back in, want to keep playing in this space? The numbers are just going to keep going up and up and up. And you've already heard Disney multiple times say, we can't afford NFL Sunday Ticket. Disney's not willing to pay $2 billion to put that on ESPN. And then when you think about what sports already do for Fox and CBS, that's their most watched live programming all year. The Super Bowl, NFL playoffs. So if it gets too expensive, I think you're going to see that start to weigh on companies like a Paramount, like a Fox, maybe even Comcast, Disney as well.
Josh, thank you. Appreciate it. Coming up, the 2023 outlook for agriculture. We'll break down some possible wild cards in the new year. That's next. Farmers, ranchers, and agricultural companies are shaping up to be winners in the current economy as the rise in prices for crops and livestock looks to push farm incomes to their highest level in nearly 50 years. Joining now to weigh in on the outlook for commodities in 2023 is 2Cream Fund's CEO and President Sal Goberti. Good to see you, Sal. So obviously it has been a weird year. I don't really know how else to put it in terms of agriculture because in large part of the war in Ukraine and the effect that that has had on grain prices globally. Barring any other events like that, what should we be keying in on for 2023?
Well, it's good to see you too, Julie. Good morning. I think keying in, this is the second year in a row where agricultural prices are well above their cost of production. And that's a very rare thing because farmers do respond with production. And so this year in 2023, we should see a return to normalcy, or at least getting there, which means grains returning towards their cost of production, wherever that may be. And how to do that is our balance sheets are very tight. We've been using more grains globally than we've been producing. Hopefully this year, we will reverse that trend and produce more grains than we use. And that should loosen up the balance sheets and maybe get prices back down to their cost of production. That's dependent on two things. It's dependent upon weather, always, and of course, geopolitics and war. But right now, it looks like we should have record crops in South America. So they're in the ground and growing, and that looks pretty good. And we're going to see their harvest here begin shortly. And hopefully the Northern Hemisphere's growing season will be very productive and farmers will respond and weather will cooperate and we'll loosen up our balance sheets on grains.
And that's the key towards the end that you also mentioned there, the weather cooperation with all of this. We were just having a discussion separately about the current weather system that's working its way through the U.S., but more broadly, what are we expecting over the course of the next 6 to 9 months, and how will that really affect some of these key commodities on the weather pattern front?
Well, you've got two problems right now. You've got winter wheat across the North America is really hurt because it didn't have enough moisture going into dormancy. So we've got a weak wheat crop coming out of the U.S. And then you've got serious problems of drought in Argentina. So their soybean and wheat crops are going to be affected dramatically there. Other than that, we should see really good weather in Brazil. That's what we've seen. We should see a record harvest, and the world needs that. And we should see really good European harvests. The Russians have, of course, had 2 record years in a row of wheat production. They may have a third, depending on what effect the war has. So we hopefully, other than the 2 spots of the U.S. wheat belt and Argentina itself, we should see better weather and better production.
So Brad just mentioned the weather activity we're starting to see rip across the country. Are there any key moves or any moves you're expecting off a storm like this?
Only in wheat. They are saying that even though snow is coming, there isn't enough snow on the ground to insulate the wheat from the cold air that's sweeping in. So you could see some legs under wheat, some support there, just because that, the U.S., while we've been declining in our wheat production for the last decade, we are still a major wheat supplier to the world. And our crop is in the worst or second worst condition since records have been capped for the winter wheat crop in the ground.
Sal, thank you so much, and happy holidays, happy 2023. We will see you, I'm sure, early in the new year. 2Cream Fund CEO and President Sal Goberti, thank you. And unfortunately, we have some somber news to bring you right now. Guggenheim Partners CIO Scott Minerd unexpectedly died yesterday afternoon. The firm is saying this in a statement. He joined Guggenheim as a managing partner shortly after the firm was formed. He was the global chief investment officer for many years, and he was really a huge figure in the investment industry, overseeing more than $300 million in assets under management at Guggenheim. He was an active donor to charitable organizations. Scott, by the way, survived by his husband, Eloy Mendez, and that was something else that made Scott somewhat unusual, that he was an openly gay man in an industry where that has not been terribly common, not to mention at the head of such a large investment firm. I spoke to Scott many times over the years and was his guest at some charitable functions, and so was able to see him in action in that role as well. And this is really a huge, huge loss for the industry. The firm saying he had a heart attack while he was working out.
Yeah, and you know him better than I did, but always very generous with his time and always really good at just breaking things down and helping the average person understand these crazy markets. He will be extremely missed.
Yes, indeed.
And the firm out with a statement this morning as well. He was a frequent commentator, as you were mentioning, generous with his time, talking both about his investments on television, via social media. It was just on the 16th of December that he was on a published podcast or one of the audio particularly audio kind of commentary fronts where he was giving even more of that insight. And so people who are often generous with their time and giving that type of insight into their investments, I mean, they're extremely valuable here on Wall Street when we can get some of their time, and he was one of those figures as well.
Yeah, again, a big loss for the industry and for us for that matter. We'll be right back. Welcome back. We are watching yet another sell-off unfold today, following on what we saw yesterday. Look at the Nasdaq there, you guys, down 2.5% here, as we are seeing this sell-off be especially acute when it comes to what we're seeing in technology. I'm taking a look at the Nasdaq 100, which I've pulled up on the Yahoo Finance Interactive, and you just see an incredible amount of red on the screen, and not just that dark red in Microsoft, Amazon, Tesla down another 6%, Nvidia down about 6.5%. The Micron news that we got late yesterday that the company is going to be cutting jobs, cutting more costs, cutting production, not helping matters, but that doesn't seem to be the only thing going on today.
No, this has been a a weird week, and I think we're already starting to get indication that this was a confusing year for investors, and next year will be as equally as confusing. We had FedEx earnings this week. They were telling you they're now having to cut another $1 billion out of their cost because demand is so weak. We had Nike's shares rip through the roof yesterday. They're noting that demand in December was strong, and they have Micron saying, look, PC sales are going to be down potentially mid to high single-digit percentage after a double-digit decline next year. And then, to add all that on, they're cutting 10% of their workforce and also warning of industrial market weakness. So lots of puts and takes, at least for this week in the market.
Yeah, within consumer discretionary, that's been one of the biggest decliners on the sector front over the course of today. That's down by about 2.5% right now. And specifically, as you were mentioning Nike, that got me thinking about some of the apparel plays that are out there, or even on the retail front. Macy's is down on the day, and last time I checked, actually right now, you're taking a look at that, that's down by about 2.5%. Thank you, Julie. Appreciate that. And then taking a look as well at some of the other major players within the segment of apparel and retail. Kohl's, that's down by about 6% right now. You've got Nordstrom down by about 4.2%. And then additionally, Target even and Gap on their side, also down, Gap down by about 2%.
And you see the selling pressure continuing in Amazon. The read here is that retailers, and what is the couple final days before Christmas, probably had a pretty bad holiday season.
Well, and being able to get some of those items to the end consumer, that's going to be even more challenging now with the winter storm system that's moving across America too.
Yeah, and one more trending ticker that I just want to mention quickly, and that is AMC, which we've been talking about, which is doing a
debt reduction initiative.
But
I'll make it simple.
But is doing it in a complicated
Yes.
way. And also the company CEO, Adam Aron, pointing out they're doing a reverse stock split because he blames the speculators on making this a penny stock. And they're going to do that reverse stock split to bring up the price of the stock. So we'll see if that is effective in getting people back into it. AMC is trading at its lowest since before it was memed, interestingly enough, in today's session. All right, that does it for us. We'll be back on Christmas Eve, and Rochelle Akufo is going to take you through the next hour of trading. She'll speak with a former CIO at the FDIC. You don't want to miss that.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast. I'm Rochelle Akufo, and here's a look at what I'm watching this hour. Isolated, Sam Bankman-Fried lands on U.S. soil as two longtime associates plead guilty and cooperate with federal prosecutors. We'll get a take of a leading criminal defense attorney with 4 decades of experience. And buzzkill, the sell-off arrives just before Santa with cutbacks from Micron adding to the downbeat tone. But we should have that holiday season rally to look forward to, right? Well, we'll ask InvestNet's Dana Doria what she sees in the days ahead. And talking tips, say you're at your local coffee shop, you order a venti veranda with 1 pump mocha, sweet cream, foam, and a splash of oat. How much should you tip the barista in this economy? 15%, 20, 25 for that order? Well, our expert has the answers. But first, we're 90 minutes into the trading day, so let's take a look at the major indices. We're seeing the selling action continuing today, giving back most of those gains from yesterday on that real GDP data coming in higher than expected at 3.2% better than the expected 2.9%. We're also seeing more resilience in the economy, could signal perhaps some more Fed moves ahead. Let's also check on what we're seeing in the Treasury market as well. In a different situation there, we see all 3 of those also in negative territory, but not to the same degree. But you see the 5-year down about 0.5%, the 10-year down just about 0.75%, and the 30-year down about 0.5% as well. All right, we'll turn to our top story. FTX founder Sam Bankman-Fried is expected to appear in U.S. court today. That's after arriving in New York late last night. This as 2 of his former deputies are pleading guilty to charges brought against them in connection with the crypto firm's collapse. We're here to discuss all the latest. We have Brian Weiss, criminal defense attorney and one of the special prosecutors in the securities fraud prosecutions against Texas AG Ken Paxton. And we're joined by Yahoo Finance's own legal correspondent, Alexis Keenan. Thank you both for joining us. So obviously a lot to unpack here. People wondering, we're seeing the connections between SBF and his deputies now as they plead guilty. What does this mean for SBF's charges?
Well, one of the things I've learned from binge watching Law and Order, much more instructive than all the dusty law books I read in 4 decades, is that the first folks to the federal courthouse get the best deals. And there's only so many seats in that lifeboat before the ship sinks. What Caroline and Gary have recognized is that it's better to come in too soon than too late. They've already cut a deal, and they are going to be powerful witnesses against this defendant. Look, just like a generation of mafiosos were done in by talking on the phone, this generation of cryptocurrency defendants are going to be done in by electronic media, by text messages, by emails. And by the way, the E in email stands for evidence. IMs and DMs and PMs and everything like that. And what this defendant is about to find out, Rochelle, is that in the federal system, there are 3 numbers he needs to be concerned with, and they're all in the 90s and they're all not good. 98% of all defendants charged in federal criminal cases plead guilty. Almost that exact number wind up being convicted. And if you are convicted, you are going to do 90+% of your time, which means at the end of the day, this defendant is looking at big time. They may be planting tomatoes on Mars by the time this guy gets out of the FCI, Michelle.
Brian, Alexis Keenan here. Now, both of these plea deals don't leave the impression really that they're deals. That's for Ellison and Wang, with those 7 charges against Ellison and 4 against Wang, now convictions, carrying 110 years in prison, 50 years in prison for Wang. So what does that tell you about the strength of the prosecution's evidence?
Make no mistake, Alexis, Damian Williams, the U.S. attorney in the Southern District, has a case with very few holes. First of all, the feds don't go forward unless they are convinced that they can make their case beyond a reasonable doubt, as any prosecutor would. But in this situation, when you've got the defendant's girlfriend, the defendant's co-founder, these are people with inside knowledge of how that operation ran. And while they don't have ironclad plea deals, believe me, they are going to get substantial reductions in their sentences if they come in and they testify truthfully. Look, make no mistake, this defendant's lawyer, Mark Cohn, is a made guy. He's a first ballot Hall of Famer. He's a former AUSA in the Eastern District, and this is not his first high-profile rodeo. He's recently been involved in the Ghislaine Maxwell case. He will have the benefit of all of the money that this defendant's family can bring to bear. But at the end of the day, guys, I'd be very, very surprised, given the strength of the Fed's case, if this defendant's case ever sees the inside of a federal courtroom.
So how would you be advising SBF right now, especially now that his associates have turned on him?
Look, this is a situation that is unenviable. You know, there's an old saying, and again, I've learned more from episodes of Billions than anything else. And Chuck Rhodes used to say that there's a reason why you never want to make something a federal case. This is why the conviction rate is draconian. The time that you will serve is infinitely tough. And in this situation, the feds are going to make sure that anybody whose DNA is involved in this failure, $1.8 billion worth of it, folks that make Enron look like they live with the Amish, those people are going to be called to account. And in this situation, we're talking hashtag triage. You've got to make the best of a bad situation, Rochelle.
Brian, Bankman-Fried is now expected to be arraigned soon, asked to enter a plea of guilty or not guilty. Certainly his calculus may have changed in the last 24 hours since he's learned about these pleas. Can he delay entering his plea in court?
Yes, but right now, Alexis, the most important consideration in this young man's life is one word: bail. Whether or not the magistrate judge before whom he appears will agree that there's a series of conditions that can assure his appearance at trial. Now, remember, he was detained in the Bahamas. What's tough in the federal system, Alexis, is that there is a presumption against release. And in this situation, if he is able to achieve release with Mark Cohn's assistance, that's huge. That is a situation where it's infinitely easier to prepare for trial. It's easier to, as you said, delay the proceedings. But if he is remanded and he goes to the MCI in downtown Brooklyn, trust me, what we know, his jail facilities in Brooklyn are going to make what he just came out of the Bahamas look like the Ritz. It's imperative that he makes bail. If not, as you said, his calculus may well have changed in the last 72 to 96 hours, guys.
So where does the process go from here? When you have the SEC on your back, you have the CFTC and the Southern District of New York all coming for you at the same time. What does that process look like?
In a word, it's ugly, Rochelle. Look, there is a process, as you've alluded to. And regardless of who you are and what you've been charged with, we have to respect that process. And after this defendant goes to a detention hearing where he will either A, make bail, or B, be remanded, enter a plea, sit down with Mark Cohn and his crack legal team and make a determination of whether or not there is any chance at all of either A, cutting a deal with the SDNY and making the best of the bad situation, or B, deciding to go to trial. In the latter event, that's obviously going to be a tough road to hoe. The more cooperators against him, the tougher it will be. And right now, Damian Williams sent up the bat signal saying, if you've got any guilty knowledge or involvement in this case, you better come in now, or it's only going to get worse.
The wall's definitely closing in there. A big thank you to Brian Weiss, their criminal defense attorney, and our very own Alexis Keenan. All right, turning now to the major markets, let's get to Yahoo Finance's Jared Blickery for a look at how the markets are shaping up as the year is almost coming to an end, Jared.
I got to tell you, Rochelle, the Santa Claus rally technically does not begin until tomorrow. It's the last 5 trading days of the year, plus the first 2 of the following year. But this is kind of representative of what has happened this year. The Nasdaq is the worst off. It's down 2.5%, while the Dow is down 1 1/3%, but it's outperforming here. Let me just take a quick survey of the landscape, and then we're going to get into some bigger picture stuff. Here are the S&P 500 sectors for today. Tech, consumer discretionary, energy, all taking it on the chin. Tech is the worst performer here. That's XLK, down 3%. I want to show you what's happened this year in the Nasdaq versus the S&P, or actually versus the Dow. Here is the Nasdaq, and you can see where we made this record high on the first day of the year, and we are now still camping out by the lows of the year. Now, you contrast that with the Dow. All right, we hit these lows in, I believe that's September, October in there, and now we have rallied. We're in about the midpoint, having clawed back about half of those losses. Now, if you you plot the gains of the Dow versus the Nasdaq, and this goes back to the beginning of the Nasdaq in the early 70s, we get this little histogram here. So when it's spiking up, that means the Dow is outperforming, as it is right now, as it has been all year long. Now, this down here was during the pandemic when growth stocks and the Nasdaq was outperforming. I show this here because this is very similar to the magnitude and breadth so far of this downturn, of this very same pattern that we saw around the dot-com bubble. So this was a very long bear market. This took several years to play out. And so everybody who was trying to front load or front run that pivot this year who got stomped on, maybe you want to wait a little bit until the next year, until reassembling or resizing those bets, or trying to reassess to see what the program is. So bottom line here, the Dow has been outperforming the Nasdaq. Is that going to mean revert? Probably got some time before that happens, guys.
So Santa not quite coming to town just yet. We'll be keeping an eye on that. Jared, thank you so much. All right, taking a look at shares of Micron after its announcement that it will slash its workforce by about 10% in 2023. You see the stock there down about 4%. Now, the semiconductor maker plans to hit this reduction target through voluntary departures as well as layoffs. In addition, come the new year, Micron will also be suspending bonuses. This all coming amid the massive wave of tech layoffs already spreading across the industry. All right, coming up, the fallout. New analysis suggests China could experience 1 million COVID infections a day and as many as 5,000 deaths. This amid reports Beijing will cut quarantines for overseas travelers. We'll get into all this next. China is reportedly scrapping its quarantine requirements for cross-border travelers in January as it continues to simmer down its zero-COVID policy. Yahoo Finance's Anjali Kemlani is here with the latest. So Anjali, how are things changing?
Well, Rochelle, scrapping is a little much compared to what they're actually doing, which is just doing away with the quarantining, that separate facility that you have to enter after arriving on Chinese soil. But what they are keeping is that 3 days monitoring at home. Now, this change had already come into play as we saw China first start to remove those COVID policies at the start of the month, reducing the amount of time that travelers had to spend in those quarantine facilities, and now doing away with that altogether, but remaining at home and monitoring after arrival. This coming at a time as we know that China is seeing an increase in cases, but our peek into what that looks like is very slim. As we know, there have been projections of more than 1 million, possibly 2 million deaths during the current surge, and a new report by Airfinity looking at daily cases possibly topping 4 million by March if the surge continues. China has already warned that there could be a new variant that emerges from this surge, and there are concerns about what the impact will be. And we know, of course, that the surge, is not being detected as much. A quote from one of the epidemiologists at Airfinity pointing out that China has stopped mass testing, no longer reporting asymptomatic cases. So kind of similar to what we see here in the U.S., the picture of how we can track these cases is becoming a little bit fainter. So just keep an eye on it for right now.
And Anjali, we know when it comes to the efficacy of some of the vaccines available in China, there's been some questions, and that Berlin has sent its first batch of COVID-19 vaccines to China. What do we know there?
Well, those vaccines may be headed to China, but those on the mainland will not have access to them unless they are German nationals. We know that China was looking at importing these foreign vaccines for foreign nationals alone, Germany being the first with the BioNTech-Pfizer vaccine, but it is unclear how many other foreign nationals will have access to this batch. In addition, we know that Chinese nationals will continue to use the homegrown vaccines for now, so that's where things stand.
So a lot of nuances still in this zero COVID unwinding. A big thank you there, our very own Anjali Kemlani. All right, now it's time for our chart of the day. And today we're focusing on Chinese stocks. Now, despite the rally they've seen over the past month, they remain global underperformers this year. The MSCI China Index has lost 26% in 2022. That's compared with a 19% decline in the MSCI All Country Index. Now, volatility has been a major driver, of course, worsened by the Shanghai lockdowns and, of course, tensions around Taiwan. The annual correlation between the MSCI China Index and the MSCI Global Benchmark has dropped to 2001 levels at 0.22. We'll be keeping an eye on trends in China and how investors might be thinking about it in the coming year. Well, as we wind down this turbulent year in the markets, our next guest emphasizes downside risk in 2023, driven by significant looming risks, including another hit to corporate profits, stickier inflation, and of course, issues with the Fed's pivot. Let's bring in Dana Dioria, Investment PMC Co-Chief Investment Officer. Good to see you. So as we look at some of these downside risks, obviously some were black swan events we couldn't predict, like Russia's invasion of Ukraine. But what is going to carry over into 2023?
Hi, thanks so much for having me. Yes, I think unfortunately a fair amount of what we're looking at right now is on the tap for next year as well. Certainly for the first half of the year, we've encountered a period of time where the market seems intent on expectations of a Fed pivot. I think we're finally getting to the point where the market is a little bit more wary and cautious around that. My expectation, just looking at the information, is that maybe second half of the year, but I think the Fed has been pretty clear. They've been very consistent about the fact that they don't want to have stop and go policy. We've seen, in the past that does not work well. The employment market remains strong. Another jobless report coming in, just confirming this. Wages remain sticky. It's the piece of inflation that's really kind of really staying high and sticky. So I do think that, the risk that we've had the second half of this year continue on into the first half of next year for sure. Top of the list. We have to continue to fight inflation, even as a lot of it is peaking, and the Fed will continue to do that.
And we have seen investors at some points getting a bit ahead of themselves with every sort of data point that comes out. But you say it's possible that the Fed pivot doesn't materialize in the way that the market expects. How so?
Well, I think, I think the market has been expecting maybe terminal rate lower than 5, maybe even January, we're not seeing an increase. And I just don't think that that's going to be the case. I do think that we continue to see increases, January meeting expectation of an increase there. And also that even if we remain flat, we're not actually easing. And I think to a certain extent for a while there, the market was sort of expecting that, just kind of a turnaround and that the rate is coming back down pretty quickly in the course of 2023. I think, again, I just don't see that happening in the near future. We do know that, historically wages, jobless claims, right? This kind of stuff can get hit more towards the end. So the fact that jobs unemployment is still low now is not so surprising, right? We would expect maybe 12, 18 months in to start to see the pain from the unemployment and, more of the recessionary conditions that we would associate outside the market happening. But that does mean that the Fed is empowered to continue kind of taking the stance it's been taking, at least as we move into the early part of 2023.
And digging into the labor market, you say that the bad news is actually good news for the stock market, but for the time being, at what point does it start becoming bad news for the markets?
Yeah, it's a great question. I mean, it's good news, obviously, in the sense nobody wants to see unemployment. But from the market's perspective, you have to see some weakening in the employment picture because we have to see wages, the stickiness of inflation in wages start to ease up because that we know that's what the Fed is focused on. So the market is kind of waiting for a report that sort of says, OK, we're peaking there, too, in terms of wage increases. We're maybe getting on the other side of that. And that in turn would obviously potentially lead the Fed to say, okay, now it's time to start easing on increases, maybe even pivoting the other way. So that's the reason that's the sort of thinking that we have here. I will say, right, there's a lot of other indicators of weakness that we're starting to see and, probably will see as we head into 2023. Corporate profits probably need to come down a lot. You're still seeing, obviously, inverted yield curve. You're seeing issues in Russia and Ukraine. I mean, we're going to be going on a year, and I don't think anybody thought that this was going to last as long as it has. China's still working through the segment you just had, right? Great information around just, China working through its policies. So there's a lot of issues that kind of loom for the market in general, for the economy in general. The labor is just kind of this holdout, but the Fed's mandate is inflation and unemployment. So those are the two things they really focus on.
So then, as we mentioned, all those factors that you just laid out there, what does that mean in terms of asset allocation? What do you do for your portfolio when you have so much uncertainty?
Well, the standard advice, of course, is you have a good mix of equity and fixed income. I think everybody really got a startling surprise this year when the 60-40 kind of failed in that respect. We saw double-digit drawdowns both on the equity and the fixed income side. And of course, that's because you had these really sharp run-up in interest rates that killed, fixed income. Of course, for the most part, we're past that huge run up, right? So now we're looking more at priced in increases, maybe staying higher for longer than we'd like. But in terms of actual losses in fixed income, I think, the general consensus is we should start to think about moving back into fixed income, even though clients are maybe, have a little bit of trepidation around that. So number one on asset allocation is, the fundamental advice of being at the right equity to fixed income ratio in terms of what your risk tolerance can handle is still very much applicable here in spite of what we felt in fixed income markets. And then I would say on the equities, you're looking probably at defensive stocks, at least for the time being, if you're trying to react to what's going to happen in the short term. So if you're trying to say, I want to feel safer in the holding and the asset allocation that I have, you're looking at quality stocks, you're looking at low volatility stocks. I would say, though, if you're in the market for the long haul, as hopefully most clients are, then, small caps, obviously being international, what markets are cyclical, right? So what's worked in the last 10 years, oftentimes the next 10 years is different. We've just had a period of time where US stocks have outperformed dramatically. So there should be an expectation that, things can swing over to the international markets just based too on valuations. But that might not be as a defensive, comfortable place for clients to be. So if they can stomach that and be, kind of have that longer term view, it's probably a good opportunity to diversify into those areas. So it really depends. Am I looking at this on a short term or longer term basis?
So there you go. Check your time horizon and your risk tolerance. A big thank you to Dana Dioria, InvestNet PMC Co-Chief Investment Officer. Thank you for joining me this morning. All right, coming up, the stroke of a pen. How important could executive actions become in the next year as a divided Congress gets up and running? We look ahead to where President Biden could go it solo next.
If they attack us with Iranian drones and our people will have to go to bomb shelters on Christmas Eve, Ukrainians will still sit down at the holiday table and cheer up each other. And we don't have to know everyone's wish, as we know that all of us, millions of Ukrainians, wish the same: victory. Only victory.
A historic speech there from the capital. Ukrainian President Volodymyr Zelensky expressing his gratitude for the billions of dollars in support from the United States in its ongoing war with Russia. But with the House about to change hands, will a divided Congress mean support for the effort diminishes? And could this mean more unilateral action from President Biden in this area as well as others? Well, Yahoo Finance's Rick Newman joins us now to discuss this. So, Rick, of course, a lot unfolding here. And as we mentioned, some of this aid for Ukraine in this bill that's going through when it comes to funding.
Yeah, that's really important. So it looks like that Congress will pass that bill this week. They have to if they want to go home for the Christmas holidays. And that would include $45 billion in aid for Ukraine. That is more money than Congress has pledged for Ukraine to date. And that would go through most of 2023. So this funding bill is for the rest of the government's fiscal year, which ends in September. So that is a lot of money, but it's also probably the case that this war is not going to be over by September or by the end of the government's fiscal year. And at this point, Ukraine's need for U.S. and Western aid is looking pretty open-ended. Now, the incoming House Republican leader, Kevin McCarthy, assuming he becomes Speaker, he has indicated that Republicans may not be so eager to just keep providing support for Ukraine. And I think that is one important reason for Zelensky's visit, to get in front of Congress as he did, to create momentum going into 2023 for sustained U.S. support. And who knows, he may be back at some point in 2023 as it looks as if Ukraine's going to need more. And that Republicans might be wavering. So a lot of it comes down to just public opinion here in the United States. And so far, public opinion supports generous aid to Ukraine, and I think that's the right move.
And Rick, of course, we know there'll be a less festive mood than you're showing here for the Democrats as we come to a divided Congress next year. Are there any things on the table that we can expect President Biden then to have to use executive orders on?
Yeah, I think so. One of the biggest things that happened in 2022 this year was the passage of the so-called Inflation Reduction Act, which is not about inflation. It's mostly about green energy subsidies. So Biden got a lot of funding for that. And 2023 and 2024 are going to be the years of implementation, and there will be a lot of wiggle room for how the Biden administration implements some of those things. And also it can do other types of things like environmental regulations at the EPA and other agencies. So that's one thing to watch for. Another thing to keep an eye on is the Trump tariffs on imports from China, which are still in place. Biden could have removed those by executive action, and so far he has chosen not to. There are some economists who say that if you got rid of those tariffs, it would actually help with inflation. And it's possible, given that 2023 is not an election year, that Biden might do that because that's one of the things he wants to do going into 2024 is get inflation completely under control and be able to claim credit for it as we get around to the next presidential election cycle. So that's another thing to watch for. And I guess the last thing I'd say on this, Rochelle, is we also know that a lot of executive actions get challenged in court, including some of President Biden's. And Biden will be mindful of that, and he may not be so eager to take actions that won't stand up once they get to the courts.
Some uphill battles then, potentially. A big thank you to our very festive Rick Newman there. Thank you so much.
See ya.
All right, coming up, square pegs and round holes. The regulatory environment means it's a wild west for crypto investors. If the SEC doesn't change its stance, what can you do? We discuss with a former chief innovation officer at the FDIC. Don't miss it.
There's nothing incompatible about our securities laws and crypto. It's really just that there's a sort of a worldwide market. Much of this is offshore. I can't speak to any one matter, but I can quote from the bankruptcy court that just 2% of the customer assets at FTX were U.S.
That was SEC Chair Gary Gensler there speaking with our very own Jen Schonberger on the scope of the crypto market and how much of an international issue it is to regulate. Meanwhile, India, now at the helm of the G20, has hinted that crypto regulation will be a priority for the group as it looks to build policy consensus around these digital tokens. Well, joining us now for more on the implications for crypto and the economy in the wake of FTX's collapse is former Federal Deposit Insurance Corporation CIO Sultan Meghji. Sultan, thank you for joining us today. There does seem to be a bit of a disconnect between what Gary Gensler is saying is available for crypto investors versus crypto investors really trying to make sense of this patchwork approach. Where is the truth in all this?
Well, the patchwork approach, that's a great way to say it. There is no consensus on this, even inside of the United States. You know, there are roughly 175 different financial regulatory bodies here in the United States, and each one of them has, to a degree, its own opinion on whether they have the authority over this, what their authorities are, whether or not they have the ability to examine or analyze some of these firms. And then the comment about being, multi-jurisdictional, multinational is a big deal. Everything from the G20 to the European Central Bank to the guys in Basel to the Federal Reserve to the Bank of Japan. Everyone has a different view on this, and there's absolutely no consensus. And in some places it's entirely illegal. In other places it's entirely built into the financial regulatory environment already, and it's going to take quite a while for any sort of consensus and then policy and rules around that to get rolled out.
So with that in mind, then talk about some of the banking relationships, because some companies think that some of these deposits are FDIC insured, and then it turns out that they're not. How do you actually make sure that you're actually doing this the right way so that you don't get that tap on the shoulder?
Well, speaking for any American listening to this, I'll say it's very simple. There is no regulation around crypto that protects you at all. It is entirely outside of the financial ecosystem. You are playing, to a degree, in the riskiest market available. The vast majority of the activity happens outside the United States. So if you were to put, $1 into any sort of crypto function and something doesn't go the way you want, you are entirely on your own. Their FDIC insurance is only for American banks that are part of the Federal Deposit Insurance System, and that there's only about 4,500 of them, and there are about another 5,000 credit unions. But that's it. There's no insurance, there's no protection. You can't call up the SEC if one of these digital assets loses value and you feel like you've been taken advantage of. As we're seeing with FTX, they had their own token, they were running a hedge fund on the side, and it's going to take years just for the FTX, bag of spaghetti, I like to say, to get untangled enough so that people can understand what happens. And as it stands, about $8 billion is missing. And I think it's very unlikely too many people are going to get their money back.
And we keep seeing these calls, obviously, for more global regulation, because FTX having some entities in the Bahamas, really making it difficult to really try and understand who should be governing what at this point. Obviously, with the majority of FTX's transactions happening in the US, that helped with the jurisdiction there. But what does this mean in terms of global coordination on this? We saw India's central banker saying, look, unregulated crypto could lead to the next financial collapse.
Yeah, it's a huge problem right now because there is no single unified system for financial regulation globally. The G20 is obviously one body. There are a myriad of international agreements and standards, whether it's between groups of nations or individual nations relative to each other. And until, some sort of structure comes into play, at something like a United Nations level or something, globally, it's not going to go anywhere. It's quite a challenge right now because the global financial order came out of Bretton Woods after the end of the Second World War, as I'm sure some people who know their history know. And out of that, only because of that kind of massive cooperation at the end of World War II to then rebuild Europe, did we create the monetary system we're sitting inside of right now. There hasn't been yet that kind of global coming together to really do something about this. You know, the Bretton Woods Committee currently has a program around this that's going on, but the participation at the central bank level, which is really where a conversation like this should live, hasn't really kicked off.
So then if you had to just name one policy recommendation that you would have to at least try and get the ball rolling in a meaningful direction to give people some clarity, what would that be?
Yeah, it's a great question, and I wish I had that perfect 10-word answer that people in the media love to have. But the simplest thing, I'll answer it in two parts. Part number one: if you're an average person who wants to get into crypto, just recognize that it is entirely unregulated. There's no security, there's no insurance, there's no nothing, and so think about it from a risk perspective like that. And the second is we really do need to have all of the central banks get together and all of the major nations in the financial world get together and really make this a priority. In India, it's a priority. In parts of the Middle East, it's a priority. Here in the United States, there are, I think, 7 different pieces of legislation working their way through Congress and have been for years, but it's never managed to make it really out of committee into something that should be legislated. So the biggest thing is for legislation to get passed that really nails where all of these different digital assets land inside of the regulatory system and who is accountable to ensure that they are regulated correctly.
I'm sure FTX collapse giving them a bit more motivation, at least, to go a bit faster on that. A big thank you to former Federal Deposit Insurance Corporation CIO Sultan Meghji for joining us this morning. All right, stay with us. Coming up, sending a message. The last time we caught up with Cameo, the group CEO told us it was aiming to give talent more tools to enhance the user experience. So how's that plan going? We catch up with Stephen Galanis next. Celebrity video sharing platform Cameo has launched a new feature to its app targeted at a much younger audience. In partnership with Candle Media, Cameo is rolling out Cameo Kids, a service that will offer personalized birthday and holiday video greetings from animated children's characters. Well, to get more insight, let's bring in CEO Stephen Galanis, and also with us, Yahoo Finance's own Ali Garfinkel. A big welcome to you both. So, Stephen, just in time for the holidays, exciting stuff here. So talk about this process. Obviously, you've had your regular celebrities, but how is the process different for getting these people on board where it's licensed animated characters as well?
Yeah, so first off, this has been something that we've been thinking about literally since we started the company. My co-founder, Martin, has twin, now 8-year-old daughters. When we started the company, they were 3 each. And he used to tell me, Stephen, if I could get My Little Pony to wish my congratulate my daughters on, a good day at school, or, tell them, thank you for being nice to your sister. He's like, I would do that every single day. And, in partnership with Candle Media, we were able to bring CoComelon, the premier, property that, kids basically the age of like 2 to 4 just absolutely devour. And as you can look at on the screen here, these kids, when they get the reaction videos, they absolutely lose their mind. And it's been just so rewarding to watch this come to fruition.
Hi, Stephen. I'd love to hear a little bit more about the addressable market that you're thinking that this could hit. Because to me, it intuitively makes sense, but I also have no sense of how big it could really be.
Look, I think the kids market is huge. One thing that was really interesting is we got really deep looking at our current customer base on Cameo. Over 70% of our purchasers are over the age of 30. So a lot of these people are first-time parents, or they have young kids, or they have nieces and nephews, or people that are just having children right now, and being able to share that same joy that we've seen millions of people experience from the core product. We think it's really big. Secondly, when we look at this kids market and the technology behind it, this is stuff that could go to a lot of different things. So, for example, you could imagine other things like anime, which is so huge all around the world, suddenly being able to be on Cameo and have a presence. We're really excited about the scalability of this technology. The talent, a normal human might only be able to do 1 Cameo per minute, but this technology at scale would enable us to do thousands of cameos per minute, which is, really, really exciting. So as long as we can get the demand there, we're able to turn these around in a really, fast period and give people an incredible experience on demand.
Now, Meta was trying to do something similar with its super app, but they're going to be shutting that down in February. Where do you go from here? I know you talked about perhaps adding anime and things like that. How do you stay competitive in this market?
Look, we have a market leading position in what we do globally. I'm Greek, and my mom, we just had a Greek wedding in Panama this past weekend, and a really big Greek singer was there. And my mom's like, why isn't this guy on Cameo yet? We believe there's over 5 million people in the world that can be on Cameo as talent. Today we have 50,000. There's 8.6 billion people on the planet. We've sold under 10 million videos so far. So we think there's still a ton of room to grow in the core market, both domestically and internationally. And then again, we're going to keep building new tools and talent that allow people to take their brand and turn it into a business. And we want to do this ubiquitously all around the globe.
Stephen, I should say my family's a huge fan of Cameo, but it also hasn't been the easiest year for tech and for Cameo. You've done 2 rounds of layoffs. So I'd love to know how you're thinking about moving forward in 2023 and what we should expect to see from you guys.
Look, it was a really tough year for the business. It was a tough year, for many companies in tech. We made a bunch of really tough decisions to make sure that the business has the runway to, keep delighting families like yours. And we're now capitalized well into 2024, which, really was a huge priority of mine, the boards and the leadership team, to make sure that we can, live to fight another day. We have had to scale back some of the initiatives that we were doing, and we're really doubling down on our core market, consumer marketplace. We're really excited about the launch of Cameo for Kids. We have Cameo for Business, our B2B offering, which has been the fastest growing part of the business. And last year we bought a merch company called Represent. So it's really those 4 things that we're prioritizing going into next year. And, we're just hoping to do more with less.
And looking at some of those prices, exciting stuff there. I know my 4-year-old nephew will be very happy to see that Blippi's on there. A big thank you to Stephen Galanis, Cameo CEO, and our very own Ali Garfinkel. Thank you both for joining us. Great stuff. All right, coming up, we've all been there. You pay $5 for your cold brew and it arrives in 15 seconds. Do you hit the 20% tip on that iPad? What if your order is a venti veranda with 1 pump mocha, sweet cream foam, and a splash of oat? Do you bump up your tip then? Our next guest has all the answers. The awkward holiday tipping season is upon us as consumers try to navigate what an appropriate amount to gift is to service workers in today's inflationary environment. Well, let's bring in Elaine Swan. She's a lifestyle and etiquette expert, and she can break down some of these tips and tricks for us. Good to see you. So first of all, obviously a lot of different sorts of service providers. You have the barista, you have someone who may be a nail tech, you're a masseuse, very different services. How do you figure out what you should be tipping?
Certainly, the best way to figure out what to tip depends on the actual person that you're tipping. For example, what you want to think about is tipping individuals who have helped to make your life easy throughout the year. These are people that you have constant contact with throughout the year. This is, as you mentioned, your nail technician, or perhaps your hairstylist, or your barber, your dog walker. If you're in a metropolitan area, then it's your doorman, or if you're in the suburbs, it might be your gardener. So these are the folks that you want to think about tipping.
And what about if it's a one-off? Say you sit down in a restaurant, whether it's takeout or a sit-down service, how do you navigate that?
Yeah, if it's takeout or a sit-down service, then these people, you want to tip them the normal amount that you would when you are taking in that service. It's the individuals who are part of your everyday life. They've made your life easier. You have constant contact with them. You know them. You trust them. And so with that, one of the best ways to tip those individuals is to use Zelle, which is a digital payment system. The reason why it's great to use this is because you know the people, you trust them, and there's a study that came out just recently with Zelle said that 48% of consumers said that they would prefer to receive a digital payment instead of cash or even writing a check. So don't write a person a check, don't give them cash and put them in harm's way, but send that money electronically. People will be really happy about that.
Now, all these things can really add up because, we're all dealing with the same, financial issues at the moment. And then you have this added wrinkle when it comes to things like the gig economy. What do you pay someone, whether it's takeout versus, say, someone who's delivering on Uber Eats? Because sometimes you feel like you only have a very limited number of options that you have to tip, or you might get your food left behind. They might not deliver it for you.
Oh, yes, certainly. So one of the things you want to think about is you always want to tip based upon your own personal budget. There's a lot of folks in our lives that help us out. And so don't feel that social pressure to tip any more than you're able to do. So for that Uber driver or the Uber Eats person or what have you, if they're delivering your meal, utilize the system that's provided there, whether you decide that you're going to tip after they deliver. So that way you can determine how that went, or before they come in. And with those tips, it can be anywhere from 10% all the way up to 20 and more.
Now, what about when it's some of these COVID-related fees that are already tacked on when you kind of look at the bill? Do you factor that into the tipping at all?
Yes, you do. Actually, you want to think about this sort of thing because the proprietor is adding those additional fees there so that this way they can cover the cost of whatever it is. If, let's say, for example, they are charging an additional service charge and you see that on your receipt. One thing you want to do, if it's your server in a restaurant, is ask the server, listen, this service charge, does this go to you or not? Just recently, I asked the server that question and she let me know that no, the restaurant gets that all together. So that prompted me to make sure that I left her an applicable tip.
Now, as we're seeing in that video there, a lot more of these iPad services that, they pretty much, you get a bit of tip shaming because they lay out the 15, 20, 25%, even if it's, you're buying a pack of gum or something small. How should you view this? And how generous are we, say, now versus, say, during the peak of the pandemic when we had all of these service workers on the front lines, doing us a service coming to us?
Certainly. Well, here's the thing I want everyone to know. Etiquette would dictate that you are not required to leave a tip at the counter with those iPad or what have you, those devices. You're not required to leave a tip in that particular instance. You want to think about this particular factor here. The individuals who are behind the counter, the barista, the sandwich maker, whoever it is, they're earning an hourly wage. However, in many instances, especially here in the U.S., many workers who are in the service-based industry, who are waiters and waitresses, food servers, those individuals, they're not being paid a full hourly wage. And so their salary is the actual tip. It's those individuals that we should tip. So I don't want people to feel that tip shaming. Don't give in to that societal pressure there is. When you see it there on the screen, just swipe to the right or click no tip and know and feel confident that you have actually paid for your service, and the worker behind the counter, they are getting paid exactly what they signed up for as well.
Thank you. Thank you for alleviating some of the tip shaming that might be going on out there. I know a lot of us are trying to figure this out, especially with the holidays. Etiquette expert Elaine Swan, thank you so much for joining us, and have a great holiday.
It's my pleasure.
All right, well, before we go, let's do a final check on how the markets are faring. We're seeing that all three major indices still hovering near session lows. The Dow, they're off more than 500 points. The S&P 500, they're down 2%. And the tech-heavy Nasdaq, they're down about 2.8%. Well, that will do it for us for now. I'm Rochelle Akufo. Thanks for watching. I'll see you tomorrow, 11 a.m. Eastern.